Hello, everyone. I'm Andrew Mais, Insurance Commissioner of Connecticut. I'm extremely proud to welcome you to Day 2 of the second annual Connecticut Conference on Climate Change and Insurance, C4I. From a personal perspective, it's good to see how interest in climate change has evolved over the years and is now approaching the level it needs to be. Climate change is a critical issue for all of us on this planet. Its impact touches every part of our world and has the potential to be not just an environmental and economic crisis, but an existential threat to us all. Just recently, we saw Hurricane Ian. It brought unimaginable destruction across the Caribbean, Florida, and South Carolina, to name a few. And it is just the most recent example of the types of devastating storms we are seeing an increase in because of climate change. According to Catastrophe modeler Karen Clark and Company, projected insured losses in the U.S. and the Caribbean will be close to $63 billion, the largest hurricane loss in Florida history. And total economic damage that could well be over $100 billion, including uninsured properties, damage to infrastructure, and other cleanup and recovery costs. These weather patterns and storm surges of this magnitude can be mitigated. Our homes and businesses can and should be better protected. This is just some of what we will be discussing today. Now, coming from a state with the second highest percentage of insured property in the country along the coast and subject to climate change, Connecticut, well, we in Connecticut have long recognized the importance of climate change and the need to work with our government and industry partners to address this threat and preserve our world for future generations. Today, we have assembled 4 panels, each with highly qualified and respected experts in their fields. You will hear discussions on combating a catastrophe, innovation, a discussion on climate risk and reporting, and what comes next. But before we hear from them, I would like to thank Governor Ned Lamont and Lieutenant Governor Susan Bysiewicz for their continued support and their efforts to address and mitigate the damaging effects of climate change in our state and throughout the country. In 2019, Governor Lamont reestablished and expanded the membership and responsibilities of what we here know as the GC3, the Governor's Council on Climate Change. In addition to continuing to address mitigation strategies to reduce greenhouse gases, the newly expanded council will also address the importance of adaptation and resilience as the climate crisis evolves. And there was a private meeting at the UN headquarters in New York last month, and heads of state and UN Secretary General Antonio Guterres called again for more action and more leadership to tackle the climate crisis. They warned that efforts to keep the rise in global temperatures to 1.5 degrees above pre-industrial levels is, in their words, on life support. Climate change is not only widespread and rapidly intensifying, but some damage is now irreversible within our lifetime. According to the Intergovernmental Panel on Climate Change report, almost 200 nations agreed and warned that the world is set to reach that 1.5 level within the next 2 decades. They said that only the most drastic cuts in carbon emissions would help prevent a total environmental disaster. We must all do our part as a global community, as a nation, as a state, as an industry, and as individuals to alleviate these efforts, to alleviate the effects on our planet for each other and for future generations. After this conference, we all will get a fresh understanding of climate change and insurance, and it is my hope this will be an enlightening and inspiring event. There is no more time to waste. There is only time for action. Thank you.
Hello, everyone. Welcome to what I believe is going to be a very interesting panel with really impressive experts to discuss the topic, which is building a mitigation program. Obviously, terribly important topic. And I will say that we are taping this on September 27th. As we speak, Hurricane Ian is passing over Cuba, heading somewhere to the state of Florida. At this point, it's not known exactly where landfall is going to occur, but it just underscores the importance of the topic. Nature throws at us what nature throws at us. The only way to be prepared is to work in advance to mitigate against potential harm, which is what this panel is all about. So today, our hearts and thoughts are with those who are in the path of Ian. And when this panel occurs, more will be known about the destruction that follows. And we certainly hope for the best at this point and wish people well facing this storm. So we're going to move into the program. We have three wonderful speakers. We're going to begin. We're fortunate to have the new General Counsel for IBHS, the Institute for Business and Home Safety, Michael Newman, who brings to the IBS such an interesting background with the U.S. Department of Treasury, in which he specialized in all sorts of important topics relevant to this panel, mitigation, insurance, even cybersecurity, and now as General Counsel for IBHS is going to help lead this organization, which is doing tremendous work and has many more exciting adventures to come. So with that, Michael, let me turn it over to you.
Thank you so much, Glenn. Let me just share my screen. And I'd like to first thank the Connecticut Department of Insurance for bringing us all together, and my fellow panelists. Really looking forward to this discussion today. And we are discussing how to build a mitigation program. So I'm going to speak a little bit about IBHS, our mission, why we do what we do, and then introduce you all to our fortified multifamily program and kind of talk through how we came up with the program, why we came up with the program, and what makes for a successful launch of a mitigation program. IBHS, the Insurance Institute for Business and Home Safety, is a 501c3 building science research and risk communications institute. We're fully funded by our members, the property insurers and reinsurers. We exist to study how to make the built environment, the homes where we live and the buildings where we work, play, learn, gather, how to make those buildings more resilient to severe weather. To put it plainly, we crash test houses. We recreate severe weather, specifically hail, rain, wildfire, and wind. And then we conduct stress tests at full scale to learn how to make those structures stronger and safer. We believe that the damage, disruption, and dislocation all too often associated with severe weather can be reduced and in some cases even prevented if we make our homes and our buildings stronger and more resilient. So I'm going to start off by taking you on a brief tour inside of our research center. This is our campus in Richburg, South Carolina. And our research center features a 6-story test chamber the size of an airplane hangar with 105 fans, 6 feet in diameter. We can generate hurricane force winds up to 130 miles per hour in that test chamber. We also study hailstones, both in the field and in our lab, as well as wildfire. We're the only facility in the US capable of generating embers and then studying how wind, embers, and the built environment interact. And of course, we study rain and wind as well, trying to prevent sites like this in the real world. As I mentioned, we're in the field as well as in our lab, and we study both commercial and residential structures, always looking to recreate that severe weather so we can see what fails first and understand how to protect the buildings where we spend so much time in, and then try to translate that science into actions that will help people. And mitigation programs are some of those actions. So I think we need to ask ourselves, how do you build a mitigation program? Well, it seems to us you need 3 things. First, there needs to be a need, a demand for some type of solution. And second, you need that solution. And then third, you need to create a market for the solution. And by that, I mean, you're oftentimes with the mitigation program creating simultaneously a supply, people who need the help and can afford it, and a demand as well. So you need both people and you need workers. So where's the need? Well, these numbers make it clear. Since 2015, there have been 124 separate weather-related disasters with billion-dollar losses, totaling over $880 billion. Of that, in 2020 and 2021 alone, there were 42 separate disasters with at least $1 billion in losses. And that doesn't even count the many, many instances of severe weather with meaningful losses of less than $1 billion. With millions of Americans living in multifamily housing, our nation can't meaningfully reduce the impact of natural disasters without building stronger multifamily housing. And that's particularly true of affordable housing, which houses some of the most vulnerable people in our nation. At IBHS, we believe in a concept we call resilience for all. The idea that resilience is something that should be available for all people, regardless of socioeconomic status, a foundational part of housing and not a luxury. So that's the need. In terms of solutions, we already actually had one at hand. The Fortified program, as I'm going to describe, has been around for well over a decade in the single family space, and it grew to the commercial space as well. Then what we had to do is update our existing program to make it appropriate for multifamily housing structures. Now, creating a market, it's that last piece, and sometimes the hardest. In the case of mitigation programs, this involves making the case why property owners should invest while simultaneously supporting the development of a workforce that understands and is excited by what needs to be done. As I'm going to describe at the close of my presentation, we found collaborating with the public sector to be incredibly valuable in setting the stage for success. So I want to briefly run you through what the Fortified program is. It's based on decades of science at IBHS. And the Fortified program is a suite of voluntary resilient construction and re-roofing programs that are designed to help property owners reduce the risk of high winds. Programs are available for single-family homes, for multifamily projects, and for commercial buildings. And while I'm focusing my comments on multifamily today, please understand that most of what I'm saying applies across all three lanes of our program. So Fortified has three different levels of resilience. The first is Fortified Roof. Through our post-catastrophe research in the field and extensive testing at our research center, we've been able to really understand the importance of the entire roof system. It's one of those things that if you don't have a strong roof, damage to your home in the case of severe weather is amplified. So Fortified Roof focuses on the things that are most important to making that roof strong and secure. First, nailing it down, using stronger ring shank nails and installing them in an enhanced pattern. Second, sealing it up to keep the water out. That's a sealed roof deck. I'd like to call out Connecticut in particular has actually included a sealed roof deck requirement in its building code, which we see as an incredibly valuable piece of the puzzle. And then third, lock down the edges, installing thicker drip edges and an adhered starter strip. And that helps protect the part of the roof that's most susceptible to wind damage. So if you do that, you're a long way down the road of resilience, but there are ways to be even more secure. Fortified Silver takes everything from Fortified Roof and adds focus on windows and doors, particularly garage doors are another one of those damage amplifiers. You want to make sure that you have a resilient garage door. A focus on exterior walls and finishes, and where applicable, gable end bracing. And then finally, Fortified Gold. And that's where we want to add a continuous load path from the roof all the way down to the foundation. Now, the entire suite of Fortified programs are available for both retrofit and new construction. We have seen that Fortified Roof is most commonly used in the re-roofing retrofit stage, whereas Fortified Silver and Gold are more often applied for new construction. Then there's a final component of Fortified that's really important. That's our verification process. It's not just a technical standard. Anyone who receives a designation from IBHS has gone through a rigorous third-party independent verification process to make sure that any home that receives a designation has in fact been designed and constructed to our standard, and that's been documented. The documentation is reviewed by IBHS before a designation is issued. So I want to just note a few important things for owners. In a study coming from the Alabama Center for Insurance Information and Research at the University of Alabama, researchers shared 3 important takeaways. First, the average cost to make a building fortified, either re-roofing or new construction, is only 0.56% of project cost. And the rate of return is also very, very good. There's an estimated internal rate of return ranging from 8% to 72%. Factors contributing to this rate of return include potential insurance cost savings ranging from $1,500 to $6,500 per building per year. And then finally, a survey of potential tenants showed that 74% of tenants would be willing to pay a little bit more to have a more resilient home. So I want to talk about success we've seen in the field as well as in analysis. Last year, Hurricane Ida caused significant damage throughout Louisiana. Amid the devastation, however, the storm also provided some really key proof points about the value of fortified in some of the highest risk areas in the country. One of the most striking stories came from when the storm and the eye of Hurricane Ida crossed directly over Lockport, Louisiana, leaving a wide path of destruction. But it was in Lockport that an under construction affordable multifamily development came through the storm with just minimal damage. Les Maisons de Bayou La Forge was 90% complete when the storm destroyed most of the neighboring properties. But this project was built to fortified gold, and it saw only negligible cosmetic damage, like some minor siding loss. Once completed in the early part of 2022, it became one of the few housing options available in this area, allowing at least some families to return. This really brought home to us and many in Louisiana the importance and the value of fortified under some of the most extreme conditions. Also, in the single family context, I'll just mention we saw success in some of the worst hit areas of the state. When Ida crashed into Grand Isle, Louisiana, winds topped 135 miles per hour. Just 2 days later, as a lot of the island was destroyed, there's a homemaker named Billy Ward who was proudly showing off a series of fortified gold homes he had built on the island, all of which had no significant damage. You could see it right here in this photo. And finally, I just want to reference the value for insurance. I mentioned it before in the context of the Alabama study, but you can see here through some analysis done with CAT models that there is an estimated reduction in average annual loss. It's a tool that insurers use of 38% for having a fortified roof on a portfolio of multifamily properties, and a 41% reduction in potential loss severity. So let's put it all together. I mentioned before the importance of the public sector in helping to stand up a mitigation program, even when that program is not a public sector program. The Les Maisons project I talked about is an example of dedicated support from organizations across Louisiana that have responded to a horrific string of devastating weather by including fortified in their recovery and in their regular construction investments. We at IBHS, along with a nonprofit called Smart Home America that we partner with closely on educating decision makers about fortified, have been working with state and local agencies in Louisiana to help them incorporate fortified into programs and projects. First, the New Orleans Redevelopment Authority, or NORA, included the standards in their RFPs, ensuring that new construction funded by their agency will be built in a way that reduces the risk of damage following storms. Shortly thereafter, Louisiana's Office of Community Development and the Louisiana Housing Corporation included fortified in an affordable housing program called PRIME that uses CDBG disaster recovery grants and to fund it. And the Les Maisons project was a recipient of that program. Over a dozen multifamily projects are being built to withstand severe weather. And the Louisiana Housing Corporation just announced another $149 million tranche of the PRIME program to help build yet more affordable housing to our standard. Also this summer, the Office of Community Development included fortified in its Restore Louisiana program, helping to bring peace of mind that Fortified can help people build back in a stronger and more resilient way. These types of investments set the stage for creating a market for a mitigation program like Fortified by including the Fortified standard in construction requirements. Entities are helping to socialize the standard, educate builders and contractors and homeowners, and create a new baseline for what affordable housing can and should look like. Here in Connecticut, we're working really closely with the Department of Insurance, the Department of Administrative Services, the Housing Finance Authority, and the Green Bank as they work to incorporate climate resiliency into more government programs and projects. In particular, we want to commend Commissioner Mais and the Department of Insurance for its strong commitment to resiliency, and that includes hosting this conference here today. So thank you all so much. If you have any questions, please don't hesitate to visit our website and reach out to me, Michael Newman, at IBHS. And Glenn, thank you so much, and back over to you.
Michael, thank you. That was excellent. IBHS is such an impressive organization, and it's going to benefit from your leadership. The nail it down, seal it up, lock it in. But what a brilliant way of boiling this down into a way that's understandable and visually you can just get it. And what's so important in terms of the messaging of all this to make it understandable and therefore doable for common folks like me who aren't an engineer like our next presenter. It was my absolute pleasure to introduce Janelle Maffei. I've been the CEO of the California Earthquake Authority since 2008, but we have a responsibility to do mitigation that state law gives us. Janelle will describe. We didn't have internal leadership that had the knowledge to lead that task. And so we created a position called the Chief Mitigation Officer, an executive level position at the CEA, and then did a national search and found the most outstanding candidate right here at home in the Bay Area in Janelle Maffei, a structural engineer, cut her teeth in earthquake engineering following the Northridge earthquake. Long and successful career, and then was willing to move back into the public sector basically and come to work for the CEA to help build and lead our mitigation efforts. So it's a huge pleasure of mine to introduce my friend Janelle Maffei, who I should also add is the president-elect of the Earthquake Engineering Research Institute, just by way of underscoring the reputation she has among the national engineering community. So Janelle, over to you.
Well, thank you, Glenn. I really appreciate that. And Michael, that was outstanding. And I'll try and draw some comparisons to what we do, because I think that very similar themes. I think that the one major difference, of course, is that I'm going to be talking about earthquakes, and earthquakes are high consequence, low probability events. And so that kind of in the field testing, it frankly doesn't happen that often. So which makes those research programs so very important. But obviously, why are we doing this? California is home to 2/3 of our nation's earthquake risk. Alaska has more earthquakes. We have more people. We've strategically placed them along the San Andreas Fault Zone. So those red areas on this map are the areas of highest hazard. And you can see that that's where our San Francisco Bay Area, the Los Angeles area, San Diego area. So most Californians live within 30 miles of an active fault. What I tell people is just earthquake country. If you're out there in the valley or in that kind of southeast corner, maybe way up at the northwest corner, maybe a little bit less seismic risk, but for most of our population, very high seismic risk. As Glenn mentioned, this California Earthquake Authority was created by the state legislature, and it started way back before the Northridge earthquake, when a law was passed that said if an insurance company writes a homeowner's policy in California, they must offer earthquake insurance. The homeowner is not obligated to purchase it, but it must be offered. So that mandatory offer law was critical. Northridge earthquake comes along, magnitude 6.7, $40 billion in damage, half of that residential, half of that insured. They lost their shirts, and the insurance industry was going to leave the state. And obviously a huge crisis, both in the insurance and in the lending industries. And so the state legislature created the CEA as a unique instrumentality of the state an authority, a not-for-profit provider of residential earthquake insurance. And we're unique in that we're publicly managed, privately financed. Our board includes designees that represent the governor, insurance commissioner, state treasurer, and non-voting designees representing the assembly and senate. But our policyholders and our participating insurers are really where our funding comes from. Mitigation was part of our charge from day one. Educate, mitigate, insure. Educate to allow homeowners to make informed decisions about their risk and what they do about that risk. Mitigate, not only transfer risk, but let's reduce risk. And then, of course, our core business, insure. So from the structural engineering side of the house, I'm very, very familiar with Fortified, and I find it to be just an outstanding idea. There is to establish essentially a baseline for how you want that structure to perform in various levels of catastrophe. And so we call it seismic vulnerability, and we have studied, and here are the top 4 types of vulnerabilities to these single-family wood-framed houses like we find on the West Coast. We are focusing with our first mitigation program on that crawl space wall. That house used to be up at the elevation of those stairs. So let me tell you a little bit about that vulnerability. Often it's referred to as a cripple wall, the short stud walls around a crawl space. And what it is these are houses constructed before 1980, before seismic codes were readily adopted throughout the state of California. We have a state building code, but of course it's changed. We learn with every earthquake. And so those pre-1980 houses, and particularly pre-1940 houses, can topple or slide off of their foundation. And you can see here, it could be catastrophic damage. You know, had that gas line ruptured, with that front door being blocked, you know, any occupant with any kind of mobility issue would have been in very, very serious trouble. And disruptive. 2 years after the Napa event, the red tagged house not yet reoccupied. So disruptive, both financially and of course to the family. But the great news, like Fortified, is we have solutions, and our solutions are you know, bolt it and brace it. And clip it. We do put some clips at the top, so I could add that third one. The idea here is let's put bolts between the wood part of the house and the concrete part of the house. Nice stiff plywood on those spindly little stud walls that surround the house, and then clip the floor to that wall. And so we've now created that load path to keep the house on its foundation. Our mitigation program, the Earthquake Brace and Bolt program, was started in 2014 with a pilot program. We did, I think, 9 houses that year. But here's what we do essentially: is we select zip codes. We started out small without unlimited funding. For those 4 zip codes, we started a pilot program, and we're now in, I think, over 350 zip codes, really well populating the areas of high hazard that I showed you along that map along the coast. We put out a registration program, and we have funding available. Register homeowners. We do a selection process that's a little bit like a lottery. When they're given the go-ahead, they get the bids. They select the contractor. We're not in that contract. Contractor obtains the permit with a signed-off building permit, of course, after construction, then and documentation from them. They get a check of up to $3,000. On what on average throughout the state is about a $5,200 retrofit, more expensive in the San Francisco Bay Area. But for Southern California, that $3,000 goes a long way. And so we've had great success. So here's our funding model. Is 5% of investment income of the CEA's cash goes into our loss mitigation fund. It's maxed out at $5 million. That's about what we've been getting for the last few years. So we started the program with our loss mitigation fund. That's the gray indicated on this graph. We did get 2 years of $3 million each year from the state budget. That's that kind of turquoise. A little bit of funding from the CEA to do CEA policyholders' homes. Important to note, our mitigation program is for all Californians, not just for CEA insured. The intent here was to really provide incentives across the state in areas of high hazard. But we've been able to leverage successfully now FEMA hazard mitigation funding, and we've had applications in for additional funding. And that's where we're seeing really great success. Our recent award of $80 million will allow us to more than double the 17,000 houses that we've retrofitted to date. More than double. We're just so excited. We start to see with our ArcGIS capabilities maps that show us really, once we're in a community, we stay in that community. We're starting to see a resilience at a block level, where people on the street hear about the program through social media and through social connection. They hear about it from their friends, their colleagues, their workmates. We're going to be moving on to our second vulnerability with a program we received funding from FEMA. It's called the single family soft story. Basically, you take out all the walls that resist earthquake forces along that lower level, and you created a very, very vulnerable structure, particularly when you have that second story. This ESS, or Earthquake Soft Story program, should start early next year. And then we have put in applications for funding to venture into the multifamily arena, like Michael was just talking about. So multifamily is considered to be 5 units or above. We do have cities in California that have mandatory ordinances to address this particular vulnerability. It's a pretty basic, from a structural engineering point, retrofit. You're going in and you're putting in elements where you've taken out those walls for parking. You're putting in steel elements and plywood walls when you can. And these are a little bit more expensive, but critical. These are structures that have partial or full collapse, and it can in fact be very, very life-threatening. So very excited to have these 3 vulnerabilities that we're addressing with opportunities not only from FEMA. There's a potential in California that we will be appropriated from the state budget $250 million starting in July of next year to address this multi-frame tuck under parking soft story issue. And so we would be privileged and excited to be able to do that. We obviously have to wait until July of next year to see if that appropriation actually happens, but we're looking for other opportunities and may in fact get FEMA funding to do that. Like Michael, I wanted to show you the success. This is not an EBB retrofitted house on the right, but rather a homeowner that retrofitted after a 2000 earthquake, so that in the 2014 Napa earthquake, they were able to stay in their house, shelter in place, the house on the left not yet reoccupied 2 years later. So this retrofit of this known vulnerability works. It's relatively cost effective. And of course, with our financial incentives we're providing in our direction, our contractor directories, homeowners are finding it to be very, very workable, very cost effective. And we're excited, as I said, to be moving into the tens of thousands of houses retrofit through this program. So thank you, Glenn, and I'll turn it back to you.
Well, thank you, Janelle. You know that the picture of those 2 houses that you just had up, I know that's a legitimate photo because I know the photographer. The photographer was Janelle McCabe. That was the Napa earthquake, 2014, I think. Janelle and I met there the following morning on the outskirts of town, and then drove into the sort of disaster area and drove around town taking pictures like the ones you saw in this slide presentation. The yellow and blue house, she spoke to the owner of the blue house came out and she talked to him, and he talked about the mitigation he had done on that property. And the house to the left of it hadn't been retrofitted and stood in total disrepair for years before they were able to finally jack it up and rehab it and get it livable again. Mitigation works, as both Michael and Janelle have talked about. Before I hand it over to Raghuveer, a quick point following the previous 2 presentations. States are trying to do more to incentivize their citizens to retrofit. Yet, unfortunately, the federal government is standing in the way. And here's what I mean. When the federal government, through FEMA, provides a grant to help a homeowner shore up their home, whether it's post-disaster or pre-disaster, those grants are not taxable at the federal level. Unfortunately, what's come to light over the last number of years is that when a state steps forward and provides grants to people to help them recover post-event, that's fine, not taxable. However, unfortunately, a pre-disaster grant designed to fund a fortified home or to brace and bolt a home, a pre-disaster state-funded grant, the IRS takes the position, is taxable. That's crazy, and it's an anomaly that exists because when Congress cleared up the fact that federal grants are not taxable, they just didn't anticipate the states would be moving forward to assist their citizens, but many are now, and yet the federal government provides this disincentive. So I just wanted to say, There is legislation pending. It came 2 votes shy of passage last year. It got tied up in the Build Back Better legislation and then passed the House, then passed the Senate, obviously. But there's going to be a big push this year to get that bill passed. And what I would say to any state out there that has an interest in someday cobbling together some money to create a pot to help citizens do these important projects, if you want to make sure that those people won't have to get a 1099 and pay taxes on that grant, join us and help us get this common sense, bipartisan, uncontroversial legislation passed to just fix this quirk in the law that taxes state-funded pre-disaster mitigation grants, particularly contacting members of the House Ways and Means Committee and the Senate Finance Committee between now and December. Terribly important to just say, this is good for our state, or would be good if we can form such a program. If you have any specific questions about a specific message to bring to your member, just get a hold of me, and I'll be happy to have you join the growing coalition that's trying to get this legislation passed. And my email address is just G Pomeroy at calquake.com. It's probably in the material somewhere. Please feel free to just drop me a note. Moving on to our next important panelist, Raghuveer Vinukolo is a PhD in with a primary emphasis in water issues. Yeah. Raghuveer, you'll describe it better than I can, but in a very important expertise you bring to this panel. We've been talking about wind, we've been talking about earthquake. Obviously, flooding represents a potential for major disaster for which mitigation efforts can be very effective. And flooding isn't, just like wildfires, the risk of flooding isn't going away. It's getting worse with climate change. And Munich Re has been out in front, really, for years and years, calling attention to the dangers inherent in climate change and the need to do more to mitigate against this harm. So with that, Raghuveer, let me turn the floor over to you.
Thank you, Glenn, and thanks to also the Connecticut Department of Insurance for this panel. I think it's a really important topic, and I'm really delighted to be joining Michael and Janelle, and along with you, Glenn. And again, my life becomes very easy after, especially Michael presents his amazing research at IBHS, and also Janelle with so much focus on from an engineer's perspective on risk mitigation. As Glenn, you mentioned, I do have a water background. I call myself as a displaced hydrologist in the insurance industry. What does he do, right? So kind of mind saturated with the topic of flood a little bit, a little pun intended there. So I think, again, I really liked some of the topics, some of the points that both Michael and Janelle hit, and those are very crucial, especially Michael mentioning about resilience is not something that should be optional. It should be available to everyone, right? It should not depend on the socioeconomic factors. And Janelle, like you mentioned about the educate, mitigate, insure. This is exactly what we is at core to what I do and what Munich Re is constantly striving for, and we put it as risk communication or education, risk mitigation or management, and then finally comes the risk transfer, right? Yeah, so that's a comprehensive way of looking at resiliency, which focuses on both physical and financial resilience, right? I wanted to give a little bit of flavor. I think Glenn and Michael have put some numbers already. So from a reinsurer standpoint, we operate globally. So just let me give some numbers globally. In 2021, which 2022 is still evolving, the natural disasters in 2021 costed $280 billion. Right? That's kind of sharing in terms of, that's the overall losses, out of which only 120 was insured. Right? It highlights how much protection gap that exists. When we compare something more specific to the US, Hurricane Ida, which A lot of people got impacted. We all know about it, about the new extremes that we are facing in terms of climate risk with extreme precipitation. Hurricane Ida is only second to probably Hurricane Harvey, right, in terms of the impact it has made. But we don't have to compare, right? But in terms of the numbers, the overall losses were $65 billion, and out of which only 36 billion was insured. Even in the US, we are only north of a little more than 50% that is insured. There is still a significant portion that do not have. And so it comes back to that question about, well, how many people still suffered, and shouldn't these people have access to resilient solutions, right? And so really, when we talk about mitigation, these need to happen at community level, at regional level, and they need to be focused so that ultimately it benefits people. And I think Janelle mentioned about now the severity versus the frequency, and I think Glenn, you also mentioned it. I think what insurance, we call it, insurance is a feedback loop, right? There is an underlying risk, and that's increasing, right? And if that increases, then so does the premiums. And how do we manage that risk in terms of the underlying risk, or which we call it as the expected loss or the annual average losses? Well, there's multiple ways to manage it. One is we reduce the risk by mitigating it, by reducing the risk, which would be the most sustainable long-term solution. Or we have to somehow adjust the deductibles and limits, really, to address that underlying the risk, so that the underlying premiums are affordable, right? So what we call it, what we at Munich Re strongly believe is that protection gap, and this is no rocket science, the protection gap which exists is a function of affordability and the rate adequacy, right? So if we don't provide a solution that's affordable, I don't think people will buy it, and we wouldn't have that much of a take-up rate for a product like flood insurance, for example. And rate adequacy is important for the insurance industry to provide a product. Again, what is insurance? It's one for all for one, right? So it's a risk pool. So we have to manage that underlying risk so that the premiums are affordable. Since I have some background on flood, I also wanted to give some numbers on flood insurance, and I'd like to also point out that, because a recent panel also discussed this, flood is sometimes in the insurance industry referred to as a secondary peril. And I really want to highlight that's not secondary to anything. It's just, if anything, so we're very sensitive about this at Munich Re. We don't think that it's an insurance industry term, but it's nothing in terms of, it's not a peril that's second to anything. And so let's look at some numbers, right? In terms of, it's one of the perils that has impacted the most number of people, and the amount of damage is second to none. And that is $1 trillion of overall losses since 1980 till now globally, right? So where is the secondary in nature? If we talk about the US specifically, again, I just mentioned about the Hurricane Ida or Hurricane Harvey, but let's just focus on, if we remove the hurricanes and see only the flooding losses, no impact of extreme precipitation from hurricanes or tropical storms, and how much losses has the US incurred in the last 5 years? That's $30 billion. Again, no hurricane-induced flooding. It's $30 billion. Out of that, 20 billion was just from the Mississippi River flooding in 2019. Now, the impacts of Mississippi River flooding were even further, because when we saw the protection gap there, it just blew our minds. It's around $200 million out of that 20 billion was insured, right? So highlights so why I'm putting all these numbers is because it's really highlighting the protection gap that exists in it. And so constantly, one of the questions that we have at Munich Re, while we develop these new insurance solutions, or as an industry, we constantly think about is how do we provide sustainable insurance solutions in the long term, right? And so going back to that equilibrium between the affordability and the rate adequacy, that's the constant thing that we have to think about, to juggle with is, and here is where risk mitigation plays an important role. So just wanted to highlight one project that we have, we partnered with the Nature Conservancy to highlight this risk mitigation, right? And focusing on the peril of flood. Of course, there's tons of examples for other perils as well, severe convective storms, or and even earthquake for that matter, and also wind. But focusing on flood, because the protection gap for flood is huge in the US too, right? At less than 5% of homeowners actually have flood insurance. So in this particular example, what we did was we partnered with the Nature Conservancy, who had partnered with the Army Corps of Engineers to say, well, after the 2019 flooding over the Missouri River, there was a levee section that failed. So as they were rebuilding it, the Nature Conservancy had a brilliant idea saying, well, this is a pinch point of a river, so why not make this section, this levee, the setback, this levee a little bit further so that the river flows more naturally. Again, why do we constrain the river, especially at a pinch point where the failure probability is high? So the Army Corps did this setback levee, which is again, makes the river flow more naturally there. But it is a major risk mitigation factor, but as well as a nature-based solution, because you're not adding any more gray infrastructure here. You're letting the river flow more naturally. So there's the ecological benefits that come up with it. But the risk mitigation, particularly what was highlighted by the Army Corps, was that the failure probability of this levee in that section, which benefited multiple zip codes, improved in terms of the standard of protection going from a 50-year to almost a 200-year protection level. So what does that mean, right? It's saying it's reducing the risk of failure of that levee section in that region, which impacted the people living in that region. So we said, okay, let's quantify that a little bit. So we just took 1,500 homes and we said, all right, let's see what the impact of this would be from an insurance standpoint. So we have our own models, proprietary models, but we also use third-party models that are accepted by the industry. And we said, all right, let's factor this risk mitigation for about 1,500 homes, quantify what would a ground-up solution, right? What would an insurance solution look like for these homeowners? Currently, less than 0.5% people have any kind of flood insurance in that region. But if we look at 1,500 homes, and in general, the region over there, the NFIP premium is about $1,000. So when we factored the flood insurance solution for all these homes as a community, again, so this was a unique solution, but that we need to remove this voluntary nature, because these all people were living in flat ground next to the river. Of course, the levee is protecting them, but there has to be, the region is flat. So if the levee fails, then most of these homes will be flooded. So we said, all right, how about a community insurance solution where every homeowner in that region will have an insurance with this particular product, factor this risk mitigation in it. And we found that a private market solution at a community level, we could offer the same limits that the NFIP offers for $315 as compared to $1,000 again, right? So what was the difference? Of course, there is the geographical distribution where it's not voluntary anymore, right? So it's everyone in the community has some sort of insurance solution. And then the biggest factor was going from that risk mitigation, which went from a 50-year standard of protection to a 200-year standard of protection. So it really highlighted the impact of these risk mitigation on these innovative solutions at a community level. So, and we started doing this across the U.S. in California and Virginia, and we're seeing similar results. So as long as there is a risk mitigation program in place, we can actually offer a long-term sustainable solution. So that's really what the gist of it is. Again, mitigation, very important. Going back to how Janelle started, is educate, which is good, so that people know their risk, so that they can plan their mitigation, and then we can definitely offer a more sustainable long-term solution from an insurance or risk transfer standpoint.
Well, that's
Thank you, Glenn.
Thank you very much. I think we got time for one question, and I'm going to direct it to the guy who's standing in front of the wall of wind. And I hope they don't flick the switch on until we get you out of here. And we don't want to see you get blown away, Michael. But we've talked a lot about mitigation programs, and things that the states and the insurance industry are doing to stimulate efforts to close the protection gap. Could you talk a little bit about how these programs interplay with building codes? Are they in conflict? Are they in alignment? Is there more that needs to be done to line those up? Could you speak to that point, please?
Sure. Thanks so much, Glenn. It's a great question. You're not going to find a greater proponent of building codes than IBHS. It is, in a very real way, strong building codes, strongly enforced building codes are a gift that we leave for our children and our grandchildren in stronger structures down the line. But even in the states like Connecticut that have the very best, most modern building codes in place, there's still a huge amount of building stock, of housing stock, that was constructed before we started adopting modern codes in 2000. I was struck by Janelle mentioning vulnerabilities in homes that are built before 1980 in California, and there are so many of those. So we absolutely need to move forward across the nation with strong and strongly enforced building codes. The building code save study from FEMA found for every $1 invested in building codes, there's $11 saved. There's a great return on investment. But we also need to do something about the homes, the buildings where people live and work and gather right now, not all of which benefited from today's strong building codes. So I would say they're absolutely both important. I would suggest that every state in the country would benefit from having a modern, strongly enforced statewide building code, and not enough states do, particularly in the middle of the country, and two, mitigation programs that can help bring those who live in older buildings up to those modern codes, or even beyond, in a way that's responsive to the risk where they live, whether that's earthquake risk in California, wildfire risk in California, flooding risk just about anywhere, or frankly, wind risk, again, just about anywhere. And if I can close with a thought, since I know there's a nationwide interest in this conference, it is this: wind risk, high wind risk, is not just a coastal issue. It is a coastal issue. It is also an inland issue, whether we're talking about derechos, straight line winds, tornadoes, and we need, as a nation and as states, as communities, to invest in strong building codes and mitigation programs to help with the risks that we as a nation face all over the country.
Well, excellent. Important point to end on. I think I want to thank the panelists, Michael, Janelle, Raghavir, and the sponsors of this important conference, the Connecticut Insurance Department, for helping lead the way in terms of helping our society address these important questions. The risk is there all across the board, and the more we can do at the front end to help people be prepared for it, the less suffering will result. So if that's in our control, we can do something about it. So thank you all very much. Thanks again for allowing us to be a part of your conference. Enjoy the rest of the conference. Thank you.
Good day, everybody. I'm Jeffrey Sikowski. I direct the Center for Insurance Policy and Research at the National Association of Insurance Commissioners. And I'm here to provide a brief overview of the NEIC's Catastrophe Modeling Center of Excellence that we have started up just this past summer. So for most people on the line here, probably pretty familiar with what has been happening over the past few years, and certainly a little bit longer than that. But here's some statistics from the NOAA billion-dollar disasters for just the past 3 years through 2021. 56 events, over $315 billion in losses and economic costs, and over 1,000 deaths in the U.S. from natural catastrophes. And we're recording this now on the eve of, or in the aftermath, of Hurricane Ian in Florida. And of course, the pressure in 2022 continues on. And what insurance regulators are dealing with here is trying to keep homes and businesses protected. Importantly, also keeping financially strong insurers and reinsurers to continue to assume these risks in their marketplaces, assisting in creating risk-resilient communities that take part in reducing losses from these events. Really trying to cut across these three things and focusing on what are the key priorities and how to move forward on those. And the NAIC has been dealing with catastrophes and responding to these events for many years. The state insurance regulators are on the front lines of these events, and this has been natural catastrophe risk and resiliency has been a priority of the NAIC. In this space, we've established this catastrophe modeling center of excellence with the key idea of really providing state insurance regulators with the same access to the necessary tools and technical expertise that the industry has in dealing with in natural catastrophes and using catastrophe models to think about those risks. And this sits within the research center because CIPR provides a neutral perspective as a research entity within the NAIC in order to build insights from data in an objective way. And the CAT Modeling Center of Excellence is going to have three core pillars of activity. The first is around vendor models. And the idea here is, again, to have access to the same information. So we're working on establishing agreements with each of the main CAT modeling vendors to collect their technical documentation for each of their perils and provide that information to our regulators through a secure website, and helping our regulators to distill some of that information, which is very technical in nature. The second pillar is to provide an education and training program on top of that, on top of the vendor model documentation collection. And the third piece is around having an applied research program to complement these other two pieces. So each of these pillars, while it looks like it's in isolation, they should all be building off of one another and having integrated activities moving forward. And we've had experience in the past in dealing with putting some of these aspects together, and this is the foundation that the COE was built on. So one example of this was in a wildfire-related project that we conducted with the Departments of Insurance in California, Oregon, and Colorado. You'll see here on the screen, the first part was we worked with the CAT model vendor, Risk Management Solutions, to collect their wildfire technical documentation, and then to further enhance that to create a summary that was a bit more digestible for regulators. We made this technical document, educational technical document, available to our regulators. Now, off to the side here is, while we're highlighting the work with RMS, we are certainly willing to work and are working with each of the model vendors in this regard. This was kind of on, again, coming back to the first two pillars around vendor models and education. And then the third pillar on applied research, we also put together working with RMS and also the Insurance Institute for Business, Home and Safety, IBHS, a research study on what is the value, the economic value of putting into place home hardening for wildfire. So we took the latest science from IBHS and also from the National Fire Protection Association, their FireWise program, and we had this, we educated our regulators around these scientific techniques. Then we worked with RMS to understand where these scientific aspects were specifically embedded in their CAT model. We ran the model then on 3 different communities in each of those states, California, Oregon, Colorado, with and without that mitigation in place, and conducted a cost-benefit analysis on top of that. So those are sort of 2 examples of the work that we're building from in establishing the COE, and that work was presented through various NAIC working groups and committees. It was utilized by the state departments of insurance and their own thinking around these issues, in particular the California Department of Insurance, as they are building out a home hardening program within their state, and also presented to industry. So working from here, the CAT COE was officially established in July of 2022, just a few months ago. And the COE was established through the Technology Task Force, and it will continue to report up, it was reporting up through the NAIC's Climate Resiliency Task Force through the Technology Work Stream, excuse me for that, and it will continue to report up through that work stream. And we have a number of activities that are underway across all 3 pillars, and we expect to grow this activity over time. And I would say, the key aspect here is this is really a long-run game. We're, working on establishing this solid foundation and continuing out the analytical capabilities of the CAT modeling COE across a number of perils, and thinking through longer-term strategic aspects around climate as well, and having research and working with the industry as an important component of that. Thank you.
Welcome to the second Connecticut Conference on Climate Change and Insurance. This is the Innovation Front panel. I'd like to thank Commissioner Mais and his staff for their leadership and the opportunity for all of us to present today. I am your moderator, Dennis Burke. I work with the Reinsurance Association of America. Today we have a diverse panel. We're going to dispense with their bios, which are in your online materials. Starting us off will be Patrick Reeder, who's the Deputy General Counsel for the American Council of Life Insurers. He's going to be followed by Julie Shue Woodward, who leads Smart Home America, a structural resiliency advocacy organization. We're going to follow her with Amy Bach, who's a consumer advocate who leads the United Policyholders Organization, which is based in California. And rounding us out in the first round of our comments will be Marissa Gillette, who chairs the Connecticut Public Utilities Regulatory Authority, PURA. So since we aren't rocket scientists, we're not going to discuss the science of how we can reverse climate change. We're going to talk about things that we know something about: housing, resiliency, and power. Patrick, the ACLI has recently launched an innovative investment initiative to help close the protection gap. Can you tell us something about ACLI and what it's thinking and doing?
Sure, glad to. Thank you, Dennis. And then I want to echo my thanks to Commissioner Mais and his team for inviting us. After the death of George Floyd, the ACLI board of directors, CEOs, we have member companies, about 270 life insurance companies. The CEOs got together and said, we need to do something. And of course, many organizations were deeply moved by all the events that happened during that summer. And our CEO said, that's important, and making statements is important. But our CEO said, we need to do more. We need to do things to really help close the racial wealth gap in America. Now, we recognize as life insurers, we have limits to what we can do. And so our CEOs gave us a mandate of saying, let's identify what we do really well, and then let's do that for good. And one of the things that the life insurance industry is very good at is investing. We invest for the long term. We make promises to our policyholders and our customers that we make good on over a 10, 20, 30, 40-year horizon. And the regulatory community, the Connecticut Department and the regulatory community regulate those investments to make sure that we are solvent, that we can make good on those claims, those promises that we make. But we said, we do significant investing. The life insurance industry has about $7.5 trillion in invested assets. They have, and much of it's very long term. So we thought and said, what do we do where we can really help close the wealth gap? And we said affordable housing and impact investing, bringing those two things together is very important. Now, the life insurance industry and the life insurance industry in Connecticut is not new to impact investing. As of 2020, the life insurers had invested $184 million with the Connecticut Housing Finance Authority and had about $837 million in commercial mortgages in apartment buildings and multifamily homes. So the insurance industry is working in this space. We thought, what can we really do? So we focused on a couple of things. One, we focused on affordable housing. Now, affordable is a term of art. It's a term of art, and it's typically meant to look at individuals who have housing needs and where the average median income, the AMI, is between 50 and 80% in the community. And that's what's typically considered affordable housing. There's another tranche above that, very important. I know that the folks in this call in this meeting are going to talk about where they are really focusing and some of the innovation that they are working on is also in what we call the workforce space. And that's an average of where the incomes of the owners and the renters is between 80 and 150% of the average median income. Think of your shopkeepers, your firefighters, first responders, police officers, teachers. And we thought we need to make sure that we're focusing on that space. So we decided that we will work on affordable housing. And then we said, we're going to make an impact, right? Let's make an impact. Now, affordable is an impact. If we are, as an industry, work together to increase access to affordable housing, we're going to be making an impact on families. If that's all that we did, that would make an impact on families. If they don't have to work 3 jobs to pay rent, if they can take their kids to McDonald's after a long day because they have a little bit more disposable income because they have a predictable rent or a predictable mortgage payment that they can afford. That's an impact. But we want to do more. And you're going to hear more about that in a little bit. But let me tell you some of the things we're thinking about. We think about sustainability. So if we are going to be investing in affordable housing, if our members are going to be investing in that space, what is not just affordable, but what's sustainable? So it's how is the house being built or refurbished? What are the, what power needs? What are the utilities like? What are the appliances like? But we're also going to look even broader, which is what's the livability? Where is the housing located? Where is this affordable housing located? Do the residents have access to fresh fruits and vegetables? Is it in a food desert? Do they have access to public transit so they can get to the doctors, they can get to their work, they can get to school? Where's the public transit? What about other livability things, such as access to Wi-Fi? Does the development have Wi-Fi? All of those sorts of things are things that our members are considering when we're looking at how do we invest. So how are we going to do it? We're going to look at long-term fixed rate investment grade debt, because that's what the life insurance industry is really good at. And there's great need for it. There's the financing network out there that works in the sort of the grantor space, the tax credit space, the foundation space, and then with banks from the equity side. And so where we think the insurance industry can plug in is on the debt side, where they bring long-term debt to keep rents at an affordable level. And I'll just wrap up my opening sort of pieces with the mechanics. So the ACLI has been asked to, and we've set up a nonprofit organization underneath the ACLI called 360 Community Capital. We're in the process of forming that. We had 40 of our life insurance companies that provided seed capital for the startup of the organization. So they didn't just say this was a good idea, they put money behind it and said this was a good idea that we're going to invest in. And we're in the process of, we have an investment committee, we're working through an RFP process with CDFI network, and we're trying to identify what those opportunities are. And I'll close the way I opened, which is the life insurance industry is trying to do what we do very well, which is investing to protect our customers and do that investing to do good. So that's what our initiative is. And I think our initiative just ties into some of the other things, Dennis, that you're going to hear throughout the rest of this panel. I'm excited about what else you're going to hear today.
Well, thanks, Patrick. And I think that was, your comment that you were basically sticking to your knitting. You know what you do well. One of the questions is, do life insurers know how to build in a resilient manner, or do they need experts? And our next panelist is one of those experts. So we'll turn it over to Julie. And Julie, can you tell us what Smart Home is doing in the resilience space, and particularly the affordable housing space that Patrick has mentioned?
Yes, thank you, Dennis. And thank you to the commissioner and the team at the Department of Insurance for having me. So I'm going to say I'm not necessarily an expert, but I'm really good at getting the experts to the table and connecting the experts to everybody that needs to talk to them. So a lot of what Smart Home America does is education and outreach and advocacy for policies at the state and local level that encourage, incentivize, and make it easier to build to a resilient level, be it sustainable and resilient. So Patrick, of course, just set a perfect vision for what a lot of sectors are trying to do right now, is focusing on affordable housing. We know, if you work in any kind of genre that touches housing or insurance or real estate, you know that we are lacking enough space for people to have adequate and safe and sustainable shelter. And affordable housing is one of the largest challenges in every single community that we have, and especially challenging in high-risk areas. So those areas, the severe weather events that can threaten risk of loss on structures and affect that economic stability of a community, and more importantly, disrupt and displace families. And so Smart Home connects the fortified standard, which comes out of the Insurance Institute for Business and Home Safety, which is just a way of building a structure that can take a pretty significant weather event more than one time and continue to function and be habitable with. It will have damage, but it will be minimal enough damage that a family or a business, if they had to evacuate, could evacuate and then come back and start recovering quickly. So it shortens that distance in the recovery process from evacuation to occupancy again. But if we're talking about affordable housing, and I loved, Patrick, that you used the sectors that would live in those, because I'm traveling right now with work giving presentations, and I just spoke yesterday to the community development agencies around. So those are your state agencies that move your federal dollars to build. And I actually was talking to them about, this is your workforce housing. So just like Patrick said, everybody uses affordable housing in a different way. But we're talking about workforce housing. If your community takes a significant weather event and faster, then your workforce is displaced. And if they can't come back, you're not reopening. So you're not recovering. So you're taking that hit to that economic base. And if it's bad enough And if they weren't in resilient enough building and they didn't have adequate insurance, which unfortunately is many, many Americans not having adequate insurance, they're not recovering and they're leaving your tax base. And so how do we fix this? Basically, we just look for the best science and we put it in place, and we know how to do that now. So I say this with absolute confidence. We know how to build a structure above the flood and to take the wind and the rain and the hail and now the wildfire. There's 20 plus, well, there's 30 plus years now of science behind it. So we know how to do it. We also know how to do it to a level that the insurance industry recognizes it, will write it in a high risk area where they're not so prone to want to write, and they're willing to back that risk. And so really the conversation's kind of done in that sense. And so we know how to build it, we know how to inspect it, we know how to make sure it functions that way. And we've had many, many of those structures over the last two years specifically be tested in extreme events in a Cat 5, Cat 4 hurricanes, and they performed wonderfully. So what does that really mean? It means that if that workforce family in that home that was resilient to the wind, the rain, and the water, rising water, for any reason that they had a hiccup in their financial situation, an emergency, any little thing that required them to have to not have insurance for that moment in that time, it means that it's not a lost cause. And this is from me spending a lot of time on the ground in local and state government. So I'm speaking from a what do we see after disaster situation. It means that family, regardless of where they are with their insurance at that moment, is highly likely to be able to continue to recover because they're not coming back to 100% loss. They're not coming back to having to pull and rip out everything out of the house and put it at the curb, because they're coming back to a structure that held in whatever high wind event it was. Yes, there's damage. Yes, there's massive cleanup to do, but it wasn't 100% loss. And so they can continue to move forward and recover. We share that messaging, we educate on what that means, we get into the weeds about how to build to fortified. And then we work in the policy sector to advocate and educate the leadership that sets policy so that builders, contractors, insurance realtors can have access to this type of building, can get it built, are encouraged to build it, and there's nothing blocking their way. That's what we do.
Well, thank you. That's very helpful, and it's sort of provides a path forward for the future resiliency. So we're glad you're out there championing that message. Another person who's championing it from a slightly different angle is Amy Bach. Amy, could you tell us what United Policyholders is doing in the wildfire space?
Sure. Thank you so much. And it really is a pleasure to be on the panel. And not only do I appreciate Commissioner Mais, but George Bradner with his department has been really sleeves rolled up and very focused on resiliency for many years. In fact, I learned from him about something that's now very commonplace, but he was the first one who talked to me about communities that have been hit by wildfires where there's severe underinsurance, people who don't have insurance, people who don't have enough on their structures, using those communities being able to tap into CDBG block grants for some extra dough. And that's become a really important resource for a lot of communities. And George was the first one who pointed that out to me. So the innovation in the climate adaptation space related to insurance is coming fast and furious. That's a good thing. And you heard a lot of important points there just now from Julie about a lot of the things that have been happening on the East Coast since we had, I think probably starting from Hurricane Andrew in '92 and the impact it had on availability and affordability of property insurance in Florida. it kind of became a breeding ground for a lot of innovation. And it really, I think, you know, the IBHS work around the rolling out fortified home programs and the various states now that have got these programs where a property owner can seek this fortified home designation, and where communities can be engaged in promoting that program, is a really important positive force right now that is continuing to gain momentum. So, you know, I think, you know, innovation is like not just sitting back and saying, oh my gosh, you know, we're powerless in the face of climate change. But it's saying, yeah, no, we're not powerless. There's a lot of things we can do. And one of those things is to make it less likely that structures are going to be damaged or destroyed, which of course has that double benefit of making it so people don't lose their homes, and then also so insurers feel more comfortable writing in those regions. So we're seeing a lot of really good progress. There's a lot of challenges in getting property owners, getting localities to get organized to do the sort of official things that have to be done, you know, become participate in the community rating system, which is a pretty challenging process, I understand, for a community, you know, like a 300-page application or something. We have an opportunity for improvement there to make it easier for communities to show their commitment to risk reduction. So that's just a note. In the wildfire space, you know, we've taken lots of pages out of the books that have been written on hurricane, wind, hail, and water damage reduction or avoidance. And I think probably, you know, California, starting in 2017, we got hit bam, 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 bam with mega fires. So we had the Wine Country fires in 2017, where 7,000 structures were destroyed in Napa and Sonoma. Then followed right on the heels of that was the Woolsey fire, which took out a lot of very high value homes in Woolsey. And then followed the same year, 2018, by the Camp Fire, 18,000 structures. So we had all these mega fires, which of course sent our property insurance market reeling, which is kind of where we are today still, where California is very much, there's a lot of parallels to what the struggles that have been going on in the Gulf Coast states, where insurers' appetite shrunk, understandably, and a lot of innovation was needed to try to do things that would allay fears, but also fortify homes, because there's always that twofer that you want, right? You want the damage not to happen, and then you also want there to be insurance on the properties, you know, that do get damaged. So in taking those pages, we look to the IBHS, because they, you know, they're an insurance industry funded research operation, which means insurers are inclined to have more confidence in their work, and that's a good thing. And so, you know, in addition to their facilities where they subject fake structures to all kinds of forces, wind and water and all that, they really amped up their research on on embers being shot at a model structure to see what happens and what we can learn. And in the last couple of years, it's been kind of a rapid progress. So in the wildfire space, in terms of innovation, we have looking to underground utilities. We have a lot of sort of the equivalent of things like elevating a home and installing flood vents to hydrostatic, vents to try to reduce the pressure of water on a home. We've taken those ideas and we have translated them into what are the things you can do to make a structure less likely to burn. And we've really learned a lot and reached a lot of consensus in the last couple of years, which feels great. So, just this year, there were several major developments in the wildfire space related to, one is an agreement on standards. So these are the things that can be done that will make it less likely for a home to burn. And we have now basically 3 sets of standards, but they're all very, very similar. There's a standard that my organization has had a working group going for a couple of years with firefighters and scientists and community advocates. And we came up with our own set of standards for what experts seem to be agreeing on, or these are the things: boxing eaves, having a Class A roof, changing out siding for non-combustible siding, and then making sure there's no wooden fence attaching to the house, which is like a wick that draws the fire. And then the most, one other facet of wildfire risk reduction is defensible space, which is kind of one of the more trickier parts of the puzzle, because it means people have to give up their prized landscaping around their home. And Julie probably knows that for years and years, it's been a fight in flood-prone areas to get people to get their minds around elevating their homes, because it's something that people just can't, it's ugly. They think it's ugly. It's expensive. It seems like a big deal. And yet we know that it's incredibly important for a lot of homes. So parallel to that is trying to get people to change the landscaping around their homes, which is actually going to be a much bigger challenge than anyone would have thought. It's a lot bigger challenge than I had really realized. I was like, oh, come on, 5 feet of defensible space, right? Turns out it's actually a very big deal. So that's one of our big challenges there. But we at least have gotten agreement on the standards. We've gotten agreement on what actually is effective in wildfire risk reduction. And now there's been a lot of innovation on resilient rebuilding. So, my organization added a whole curriculum unit to our post-wildfire education program that we do in these areas, where we teach people, here's something called autoclave concrete, and here's some insulated concrete forms, and, different ways that people are now building homes different from stick building. Now, a lot of this is about, changing people's mindsets. And of course, a lot of this is, the biggest problem is not the rebuilds. It's easier to kind of make the rebuilds better, make people comply with building codes and teach them about, and I think like our friends in the Building Industry Association are really embracing the concept of resilient rebuilding. And they're really, there's a lot of good work being done in the home building industry to incorporate resilience in rebuilds. The problem though is the already built structures, and that's of course the rub. That's the majority of the challenge, is getting people who are like, my house is fine, why do I need to spend money on it? It looks fine, it is fine, why do I, it's like the challenge of getting taxpayers to want to finance infrastructure repairs. It's like, really, I'd rather have more cops and dig up the ground and fix pipes that you can't see. So those are challenges, but there's a lot going on. And the last thing I want to say in innovation, there are 2 things. One is there's a lot of tons of innovation in risk mapping and aerial surveillance and sort of companies that are now selling data to insurers that helps them look at the risk at a more granular level, which is a good and bad for the consumer. The more the insurer knows about, can see and looks at your roof and can see it, the less likely, an insurer is going to want to insure an older home that maybe has deferred maintenance. And obviously you heard about, from Patrick, we all know what a tight budget most American households are on these days. And so again, asking people to spend money on things that they think are non-essentials is a very, very tough. But there has been a lot of good progress in in terms of like cost effective risk reduction strategies. So those are positives. And then the last thing is that several wildfire prone states have now passed laws that say that if you lose your home in a wildfire and you decide, I don't want to go through a construction project and rebuild, I'd like to just replace my home by buying. These states now have adopted laws that say that the insurer will pay the same amount that they would have paid if you had rebuilt towards the purchase. And that's actually a bigger deal than it seems like, because what we're doing with that law is helping people not rebuild in the WUI, in the wildland urban interface zones, getting them out a little bit of potentially of harm's way, which I think is a really good thing. So hopefully insurers are seeing that as a positive. I think there's always some concern, when you bring on a new mandate that it's going to, drive costs up. But in this space, I feel like there's a lot more collaboration between the insurance industry and housing advocates and municipalities, because, a lot of these areas that have gotten hit by disasters are struggling, with shrunken property tax bases and vacant lots. So we all kind of recognize it's in everyone's interest to get insurers to get to a better comfort level so that they can continue to insure properties that are more in harm's way than we thought that they were in the past.
Well, great. Thanks, Amy. And that's an interesting and welcome perspective. And, you gave me the perfect segue to our next speaker, because you said we are not powerless in the face of climate change. And our next speaker can talk to us about what she in the regulatory space, as well as the utilities, are concerned about in the Connecticut, I have to remember where I am, in the Connecticut utility space, and what sort of initiatives you think and the utilities are undertaking already in terms of climate resilience. And you've already mentioned to me about the fact that Connecticut is a forested state, which most of us who drive, along I-95 are not particularly aware of. So please share your perspective.
Thanks, Dennis. And I want to echo everyone's thanks to Commissioner Mais and his staff for organizing this important event. I was able to participate last year and had a lot of takeaways that we have factored into the proceedings that we have. I know everyone in the insurance space is familiar with regulation. So I essentially hold a similar role that over the public utilities that are investor owned in the state of Connecticut. And listening to the speakers that went before me, there's really a couple of different ways that we have to approach the issue of resilience and climate adaptation from the utility perspective. Certainly, we could have a whole panel conversation on the role of utilities and their infrastructure in causing the wildfires in California, as well as the ramifications of non-resilient infrastructure, across the country following storms. But I'd like to circle back and kind of pick up where Patrick and Julie were leaving off with affordable housing, because one of the things, I think utility regulators focus on most of the time is what I was just saying, the resilience of the utility infrastructure at large. But there's also a way to approach resilience and climate adaptation at the, the more granular level. And we're starting to play a role in the space of affordable housing as well. We're hearing Patrick talk about they're looking at utilities and the ability to afford a utility when you're in an affordable housing is something that is not necessarily a given. And I think that there's a nice, opportunity for an interplay between, the investment in affordable housing and utilities. So in Connecticut, 2 legislative sessions ago, they passed Public Act 21-48, which was kind of our first foray into looking into this. And specifically, it qualified affordable housing as an eligible customer in a lot of our renewable programs. So residential renewable programs, I should be clear. And, that's caused us to look at affordable housing, the definitions, and the ability of that housing. I think there are experts on this panel about the ability of the housing itself to withstand, some of these climate events, but the utilities around them, just because the infrastructure that the house is able to withstand the event doesn't make it necessarily habitable if the utilities for that house have gone down in a major event. So, where our public act comes into play and where I think the utilities can play a role is in helping to stand up what are essentially nanogrids. So by that, I mean, solar on the roof of these affordable housing units paired with battery storage, which is behind the meter. So you're essentially setting up this housing epicenter for your workforce to be able to come home, not just to, running electricity, because the solar and storage has allowed you to stay online even when the grid at large is down. But additionally, people don't think about water being affected by a lack of electricity. And it is. A lot of folks who are on well water, for example, or city water, when the electricity goes down, your heating source with natural gas is affected, your water is affected. So really, I think there's a place for utilities and their regulators to play in this space and kind of bring everyone together, whether it's focusing on the infrastructure that the utilities have at the more global level to make sure that they're keeping up with their infrastructure and it's not causing wildfires or contributing to events. And also at the more granular level to make sure that the affordable housing is not just able to withstand the climate event, but is able to be habitable because we've created this, grid in light of the larger climate impacts on the utility system. I'll stop there. I really welcome the participation in this conversation. Like I mentioned, I had a couple of takeaways from last year, went back and was able to talk to my utilities about how they insure themselves. It's really been eye-opening, not just today, but last year. So I'll conclude by thanking my fellow panelists and everyone for including us in this conversation. Thank you.
Thank you, Marissa. And I would love to continue this conversation for an extended period. And we should have had two hours as opposed to 45 minutes. But we're moving along, and I'm trying to get a couple of quick questions in for everyone. I think for Patrick and Julie, I think Amy brought up and I think Patrick touched upon it, the difference between new construction or rebuilding after a disaster and the existing built environment, which of course is the biggest area of any kind of structures that exist, are the ones that are there, and everybody knows the greenest structure is the one that doesn't wind up in a landfill. So how do we improve the existing structures as well as make the newer structures better, and what sort of challenges are you seeing from the public policy and builders, et cetera, who may or may not have the same view of climate change as the residents of Connecticut?
And I'll let Julie, and let me take a first swing at that. Julie, you've got the more technical answer. Let me just say it from a financing standpoint. When we think of affordable housing and this impact investing, we think in terms of new construction, new units, new affordable housing units brought online. But there's an acronym that is used in the space called NOAH, N-O-A-H, naturally occurring affordable housing. And that is your refurb. That is when you go back into a housing development and you rebuild them, you tear them down, you rebuild them, and then you put in the more efficient utilities, you put in the more or appliances, et cetera. And so this initiative is really looking at both the new construction, but also this naturally occurring or this rehab. And we think that's going to be something very important. And you're right, the sustainability is going to be very important, the resilience. Again, a little off topic, but also one of the challenges it creates is what does the livability things? In other words, you're building a new construction, you know where you're putting it, you're rehabbing an area, you can't move it. That's where it is, and you're building it in that space. And so if it's already in a food desert, it's going to be in a food desert. What do you do about that? If it's already in an area that doesn't have access to public transit, it's not going to have it. And so it takes a broader view when you're looking at this naturally occurring or this rehab. So still part of our initiative, and we think it's one that creates some great opportunities, but also does create those challenges. And I think Julie's probably got a better view on, kind of the challenges she faces.
So it always comes down to the money. And, I start off by saying, I know that sounds so cynical, but that's the reality. It always simply comes down to the money. So homeowners who own their home in a 30-year mortgage are going to have to re-roof, every one of them. With the hardening of the insurance market and the challenges that we're seeing that are only going to continue to get worse, re-roofing is not 30, 25 years. Homeowners are not able to really right now. Homeowners have this thing where they just wait for the damage so the insurance will replace the roof, right? So that's not working out for a lot of people, and more people than you. Those roofs are now being required to be replaced at pretty much 15 years in a day, or their insurance premiums are drastically changing. And part of that is because the largest losses the insurers face every year is replacement of contents because of water intrusion, because the roof was lost in a high wind event. And it can be a really bad thunderstorm in the Gulf of Mexico regions. So replacing the roof is like the easiest, most cost efficient, especially if a homeowner is doing it at that time of re-roofing. That's just organically, it's that time to re-roof. It is crazy affordable. Standard. Any roofer can do it as long as they can follow directions. They can do it. And they can do it affordably. They might not agree with you at first, but that's my job, is to educate them. And once they go, oh yeah, I can do that. That right there reduces the risk of that existing building from a significant loss by a ginormous statistical point. And I never say that statistical because everybody wants to argue that, but it's a significant reduction in risk. So, and then insurers are very much attracted to that because they know they've got the research because they paid for the research. So they know what that reduced risk. That's the quickest, easiest way for existing structures. Flood, that's such a nightmare situation because elevating a slab on grade home is really, really cost prohibitive. But there is innovation out there in that, FEMA launched the Building Resilient Infrastructure and Communities programs 2 years ago. We've gone through 2 cycles now. The Storm Act was signed 2 years ago, and it's not quite up and live yet, but that's another federal government financing opportunity. States can go after both of those different funding sources and empower local communities to help elevate. So there's going to be money that states and local governments can access to get the elevations done because they're very, very expensive. And the reality of the flood zones now, yes, some people would say there's places that humans should not build and live. That's never going to work. Because everybody wants to retire where they should not be building and living. So then how do we build and live in those places? And really, you got to be above the flood, and you've got to be above the flood for the next 50 years. So you can't just build above the BFE, the base flood elevation. You can't just go 4 feet above the base flood elevation. That jurisdiction has to have the political will to say, okay, we know this is what our flood looks like 20 and 30 and 40 years out. And so you're going to have to build to this, but they can't just say that, right? Then they have to be able to say, and we're going after money to help meet you somewhere in that financial commitment to get your structure there. Because buyouts are not really an option. We don't have enough housing right now in the United States for everybody to have safe, quality, resilient housing, period. So we can't necessarily, as much as buyout works, and I did that for a long time, as much as it works, we don't really quite have the luxury right now to take a whole bunch of houses down and leave them in open space, because now we've just made the lack of affordable housing worse. So what is it that we can do? And there's a myriad of things. They all take money. And so it's really, the challenge right now is for smaller jurisdictions figuring out how to do that, right? They may not have a full staff. They may not have the ability to do that. For homeowners, it's just understanding what their options are. And homeowners are really busy all the time. So it's really hard to get them to sit still and actually understand what they can do, and then giving them those options and pathways to that. So there is a way to get us where we need to be. And a lot of it is education, and a lot of it is supporting communities and states so that they can access the funding that's now available for them to put those plans in place and to make all those dots connect at the local and state level.
Thanks. Since we're in the super rapid fire section right up against our time cap, Marissa, what would you want the insurance industry to know, and the insurance regulatory industry to know, and how could they help the utilities achieve their resilience goals?
I love that question. I think that there's a lot that we can actually pull from this industry, from your industry, including a lot of the best practices that you all do with forward-looking modeling. So like our utility space, for example, we do forward-looking modeling. It's mostly about the demand for electricity or the demand for fuels, rather than forward-looking modeling about the impact or intensity or frequency of climate change events in the future. So I think there's definitely some lessons we can pull from you all. And I would say vice versa, I'd love to see more of a collaborative relationship between the two industries, because as I alluded to just a few minutes ago, there's so much about ensuring that structures and other things remain habitable that rely on the resilience of the utilities, either at the macro or micro level. So I welcome any additional outreach. We've got some great relationships between our regulator at the insurance department and my regulatory agency in the utility space. But if you haven't made those connections in your state from the insurance to the utility world, definitely recommend it. And that would be, my number one takeaway is do some relationship and liaison work between the two industries.
Excellent, thanks. Amy, quick, super rapid fire. What do you want regulators and the industry to know?
Well, the more that insurers voluntarily signal to their customers and potential customers that they believe in the value of risk reduction and that they will support it and that they will reward it, the more people will be in a position to feel like, okay, I should spend this money. I should spend this time because my insurance company is going to reward me. So as much as insurers, don't want mandates, the more that insurers do voluntarily, the better. And we have seen some of that in California, and we want to see lots more of it. So thanks, Dennis.
So thanks, Amy. And I thank the entire panel. I think one of the things we heard today is that climate change is challenging because one size doesn't fit all. You could have floods, you could have wildfires, you could have hurricanes. Hopefully that's in the not too distant future, that's not going to change, and that everybody will be subject to every catastrophe in the same areas. But you need to build for what's expected and what's for the future. And from the property and casualty space, I think economically it makes sense to build as strong as you can for the environmental challenges that you will face and ensure the rest. It has to make economic sense on both sides. And the insurance industry is willing to work with the utilities and others to achieve a resilient future for all. So I'd like to thank you all. And it was a great panel, and I wish we had more time. Thank you very much.
Thanks, Dennis.
Thank you.
Good day. Thank you for the opportunity to speak at the Connecticut Conference for Climate Change and Insurance. I am Hong Guo, Chief Insurance Officer of Arbol. Arbol is a fintech insurtech company that specializes in providing data-driven solutions, including insurance, for managing climate risks. Our insurance headquarters is in Darien, Connecticut. So from an insurance operation perspective, we are a Connecticut local company. We have a Connecticut domiciled insurance agency that is licensed in all 50 states. And we have a sponsored captive insurer called Climate Risk Insurance Company. I will provide a brief introduction of what we do and then give some case studies on using insurance for managing climate risks. At the very high level, ARBO offers two types of solutions. First, as an insurtech company, we offer protection products in the form of insurance and reinsurance to help businesses manage financial losses resulting from climate risks. Second, as a technology company, we offer data and analytics services for climate risk assessment for global businesses. Now let me talk about our insurance and reinsurance product. We take a unique data-driven approach in designing how our protection products work. Instead of paying losses based on traditional loss adjustment, our protection is based on predefined data parameters, such as temperature, rainfall, drought, water level, wind speed, solar irradiance, crop yield, etc. We call this type of product parametric protection. Our parametric protection products are often offered in insurance and reinsurance forms. Our parametric protection products are offered in insurance and reinsurance forms, depending on our customers' needs. We leverage our extensive state-of-the-art global climate data platform, AI-based underwriting algorithm, and a digital transaction and operation platform to bring pricing efficiency and operation efficiency to provide protection for climate risks and fill the coverage gap created by the lack of sufficient coverage by traditional insurance. Let me offer 3 examples. First, a parametric yield product for agribusinesses. American farmers have access to federal subsidized crop insurance programs to protect them against loss in production in bad years. When the yield is low, farmers can pick up a check from the federal government. However, the agribusinesses offering services along the crop supply chain don't have access to such protection. These businesses, such as cotton gin, warehouse, transporter, harvester, grain elevator, etc., rely on processing local yield to make a revenue. And when the local yield is low, these businesses suffer. They face risks of suffering huge financial losses or even going out of business. Identifying the coverage gap, we came up with an area yield index-based insurance product for such agribusinesses. They now can buy an insurance based off a customized county and crop-based yield index. Their insurance agent can create such a customized index based on what crop they process and where they source their business. If the actual yield index is below a predetermined level, insurance will start to pay. For example, a cotton gin in Texas can buy protection at 75% of 10-year average of cotton yield in the counties where it sources businesses. If the yield index, which is based on USDA published county level cotton yield data, falls below the 75% trigger, it will receive payment from insurance. One of the cotton gin owner in Texas says, I mean, it was something that is going to end up saving my business. That is how this parametric product help provide a solution to such businesses. The second example is a parametric wind generation protection insurance for the renewable energy sector. A power utility owns offshore wind generation assets and needs to hedge against a shortfall in generation due to lack of wind speed. In order to do this, they can purchase a protection that would pay when wind speed is below a given threshold for a given period. This protection and the payout would provide them a daily hedged cash flow to fulfill power delivery obligations and help lower cost of capital and revenue volatility. The third example I would like to give is a parametric reinsurance for hurricane risks. We all know that homeowner insurers in Florida rely heavily on hurricane reinsurance. In recent years, traditional reinsurance support has significantly reduced as reinsurance companies withdraw from Florida market. Arbo designed a parametric reinsurance product and brought in completely new risk capacity to support a Florida home insurer. With this product, the payout is determined by each insurance policy location's distance to a particular hurricane track and the maximum sustained wind speed captured along the hurricane track. The data is transparent as it comes from the National Hurricane Center, and the calculation mechanism is transparent as it is pre-agreed. So all the payouts for each policy location for a particular hurricane event will be calculated and be aggregated, and a reinsurance structure is applied. Hurricane Ian that just hit Florida hard 2 weeks ago is a good validation of this product. Compared to the months or even years lag for traditional reinsurance to pay out, as losses after such a huge event take a long time to be adjusted and settled. The buyer of the parametric product will know if they will receive a payment as soon as the hurricane track data is published by the National Hurricane Center, oftentimes within 1 or 2 months' time. Such timely payment is crucial for the Florida homeowner insurers, which are often operate in a very, very tight cash flow environment. Through these 3 examples, we can see that parametric insurance is playing an increasingly important role in areas where there's a gap in traditional insurance coverage. Parametric insurance is especially helpful in providing protection against emerging climate risks, for which there's a lack of loss data for traditional insurance rate making. As a Connecticut business, we fully appreciate the strategic initiative on climate change by the state and look forward to contributing to climate risk management efforts by the state and other Connecticut businesses. Thank you.
Good afternoon, everyone. Welcome to our panel entitled What's Next on the Climate Front. Today we're going to be talking about what is next on the climate front and how industry impacted by these events are managing. We're going to hear from an excellent panel here about initiatives they have underway and importantly where these are moving forward. And we're also trying to really highlight how the U.S. insurance regulatory community can be involved and engaged in these efforts. So speaking of that, I'm Jeff Sikowski. I direct the Center for Insurance Policy and Research at the National Association of Insurance Commissioners, which climate and resiliency is a key regulatory initiative for the NAIC. This is due to the fact that what we continue to see is a large insurance protection gap related to natural catastrophe events. much of this falling on low income and socially vulnerable communities. Not only is there a protection gap in regards to homeowner property, but there's also currently a physical and social infrastructure investment gap that also has strong implications for vulnerable populations. And both of these points, I mean, you know, we're recording this about a week or so after Hurricane Ian went through Southwest Florida, and both of these aspects are currently playing out there in terms of the protection gap and significant damages. And of course, the role of extreme weather under future climate will only exacerbate, you know, these issues. So how can industry and regulators work together to make progress in this space, and really, you know, what sort of tools and initiatives are available to address this? And we're trying to find out, you know, where they're headed. So I'm very pleased to have our three panelists, Stacy Swan from Climate Finance Advisors, Stephen Rothstein from Ceres, and Suzanne Scatliff from AXA XL. And what we're gonna do here is we're gonna kind of walk through each of those in turn for them to touch upon sort of what they're engaged in and where they see things moving forward. So I'm gonna first turn it over to Stacy from Climate Finance Advisors. And Stacy, if you wouldn't mind just kind of introducing yourself and your company and try to start to address some of the things that we just touched upon here in the introduction.
Sure thing. Thanks, Jeff, and thanks for having me on this panel. This issue is really important. It's super important in how we line up our kind of financial toolkit, I would say, in the immediate future and kind of, you know, 3, 5, 10 years from now, how we actually kind of get our hands around the climate-related financial risks, not just from an issue spotting perspective, but also from a actually solutions perspective, because you're right to point out the protection gap is wide and widening. And if we don't, as a collection of financial stakeholders and policymakers, come together to take care of this issue or kind of mind this issue, that gap will kind of become increasingly wider. So let me take a step back. I'm Stacy Swan. I'm the CEO of Climate Finance Advisors. We are a consulting firm that was founded in 2015. Our work is at the nexus of climate and finance. We are a collection of finance practitioners, bankers, private equity, investors, folks who work kind of on different types of financing, structuring, and policies and programs, and entirely on this climate issue. I will say that in 2015, when CFA was founded, primarily most of our work was around not just energy and renewable energy and the mitigation side of things, but really around kind of structuring funds. And then with the dawn of TCFD in 2017, we have really started to broaden ourselves out, because climate-related financial risk is something that all financial investors, no matter where you invest and how you invest, is something that's important for their investment decision-making. So since about 2017, 2018, we also do a lot of work on this issue of how to identify, assess, quantify, and then manage strategically climate-related financial risks. I will say, as it relates to insurance, I think a number of people still believe insurance is a risk solution. We still do a lot of work with people saying, no, actually insurance is risk transfer. You also need to reduce risk while you're also transferring risk. As an instrument, you all know from the insurance industry, insurance products are about transferring risk for a certain period of time for a fee in order to kind of help manage some of the risk that you might need to be managing and from a financial perspective. And I think that understanding is increasing, but it's really important as you pull climate and insurance together in a conversation, making sure people understand insurance mechanisms are risk transfer mechanisms. You also need to reduce risk, which is where, from a regulatory perspective, insurance regulators can play an important role as well. So taking a step back, setting the table, we know we've locked in enough warming at this point that even if we stopped emitting today, we still have increasing climate-related physical risks that we will need to manage. They're being realized today. We saw it last week with Hurricane Ian, and the intensity of some of those physical impacts is expected to increase even regardless of whether we're emitting more. We obviously know we have a lot to do to reduce emissions, but we still have a physical resilience climate risk issue at hand for all of our hard assets and a lot of our social infrastructure. With that increased warming, the climate impacts will increase, and these will result in financial impacts. When it comes to financial impacts, the ability for people to manage those does depend on whether they have access to affordable insurance to cover some of the hazards that they might need to be kind of managing around in the future. So this is kind of a big picture context. Every single part of the financial sector is starting to talk about this. And I give a lot of credit to TCFD for giving us a common language, regardless of whether you're thinking about TCFD as a disclosure or you're just an investor of different types trying to get your hands around it. But what happens with this better understanding of climate-related financial risks is that we might have a shift towards more climate-resilient assets. That's a good thing. There's the Inflation Reduction Act in the United States, I think, is going to be incredibly helpful for accelerating some investments on the climate side. But I think we also need to make sure that as investments, climate and clean energy investments are accelerated, we're also paying attention to physical resilience because that will help us as we're managing risks on the other side. Also, new business models and opportunities are going to come about and be invested in with a better understanding of this climate-related financial risk. And you're seeing this in the context of the data and analytics space, where climate-related data and analytics are kind of companies are kind of coming up over and over and over again and being developed kind of all the time. We're tracking more than 100 of them right now, and we're also seeing a number of those companies come together with different types of solutions for climate-related financial decision-making, which can be useful for thinking about how insurance is applied. But also with a better understanding of risk, obviously, is a potential for capital flight. And this is where this protection gap question becomes really important, because these are real challenges for certain types of vulnerable communities, certain types of communities where there's been underinvestment historically anyway. The acceleration of some of these climate-related risks and the increased awareness of risk from investors of all types might be a little bit of a perfect storm, which results in some of these areas actually having less access to finance, less access to investment, less access to affordable insurance, which can help them manage climate-related risks when they happen. So these are pretty important issues to be keeping your eye on from a community perspective, from a homeowner's perspective, from the kind of, a consumer purchaser of insurance perspective. We need to really start thinking about whether and how we can provide not just the affordable insurance underwriting that those communities need, but also the resilience measures that might come along with making them not just more resilient physically, but also more attractive underwriting kind of customers from an insurance perspective. The other thing is, so you have communities, you also have the resilient infrastructure investment that's going to be coming online. This idea that resilience has to be baked into how our different parts of our economy and infrastructure is done is at the top of mind of a lot of infrastructure investors. They're starting to ask the right questions about whether certain types of bridges, roads, transportation, energy infrastructure are also resilient. Is really important in terms of how those pieces of infrastructure are designed, and also will kind of result in, I think, better alignment of interests when it comes to thinking about the insurance needs for those types of assets. So that is kind of the context. Insurance is one of the regulated industries within the financial sector. You have sitting and at the federal level, you have a number of different regulators regulating different parts of listed equities and banking, but also insurance. And what's been nice to see in the last couple of years is some alignment among regulators that climate-related issues are important to be thought of within these regulated industries. And insurance is a key tool in the toolbox to help us start to figure this out. Insurance are among the world's largest long-term investors as well. So on the underwriting side, obviously they're on the front line of providing products to communities and individuals and homeowners, but also as an investor base. They're also a really important voice in terms of trying to push the resilience agenda through the things that they might invest in or the assets they might purchase as long-term investors. However, insurance as an industry is often constrained by regulations, which are very important, designed to guarantee insurers are sufficiently solvent when they have payout claims. That's something that has to be managed kind of as a regulatory issue. And if you start to believe that climate-related issues might accelerate some of those payouts or the frequency of some of those payouts, that's something that has to be managed from a solvency issue. And as a result, it might also have some restrictions in terms of, or it might result in fewer dollars being available for the investment on the long-term investor side of insurance portfolios. So those are kind of two competing internal kind of parts of the scale that are going to be important to be mindful of. National insurers, investment portfolios tend to be untapped when it comes to thinking about infrastructure and thinking about the different types of infrastructure investments that could be brought to bear. But insurers play a really important voice and have a really important voice in this conversation and could be potentially taking on a little bit of more of a kind of stronger role in pushing kind of for resilience on the infrastructure side. So those are kind of interesting kind of things to think about when you think about insurance and the role that insurance can play. I also think investors who think of insurance as part of their solution, right? Investors are kind of putting in their debt or their equity into different types of assets, whether it's infrastructure or thinking about, even kind of community level assets. And they also want insurers to play a really important role in helping to not just be able to transfer those risks for a certain period of time from a financial perspective, but also play a really important role in helping to kind of push the resilience investments that are needed, right? If you can invest in something such that it is more resilient to the hazards you expect to be coming, then it's in everybody's self-interest. Obviously, if you take a homeowner, it's in the homeowner's self-interest to kind of be more resilient from a physical perspective. It's in the mortgage holder's self-interest that asset not be destroyed if a certain type of physical event comes around. But it's also in the insurer's interest to kind of make sure that asset is more resilient in those circumstances because their payouts are lower. So there's an alignment of interest there. And I think that there's some more work that can be done to bring some of these stakeholders together to move forward on kind of addressing climate-related resilience investments at all levels, at the community level and at the infrastructure level. And I think that that's something that's yet untapped. We are starting to see from some of our work, we're starting to see, obviously there's a lot of awareness on the investor side. There's a lot of understanding on the investor side. At the kind of consumer side or the homeowner side or the infrastructure asset developer side, that awareness is a little lower, but growing all the time. And then on the insurer's side, recognizing that most insurers tend to be pretty conservative in their approach to markets, having some ability to kind of unlock that really important role that they can play, both in promoting resilience and also kind of connecting up the conversation would be useful. I think I'll stop there because I'm excited to hear about some of the other speakers on the panel. I will just say TCFD as a concept has been incredibly valuable for creating this common language among different types of investors and different types of stakeholders around an asset, whether it's infrastructure or not. And I think that there's ways to start having the conversation such that insurers, as one of the most important signalers of risk in the market, can start to push and promote resilience in a more consistent way, and particularly on the physical risk side. And with that, I think I'll stop.
Why don't we'll come back after we hear from Stephen and Suzanne. So, and again, thank you for the mentioning of the TCFD and sort of your addressing this as providing a nice baseline understanding of what's transpiring. And so our next panelist here is Stephen Rothstein. Stephen, I know you've been involved on the TCFD aspect with the NEIC, providing some education for regulators around how to think through some of the TCFD responses. So why don't you maybe describe some of that, but I'm sure you want to talk about it a little bit more. But again, as we did with Stacy, maybe you could take a couple minutes at the beginning to introduce yourself to the audience, kind of talk about Ceres a little bit more broadly, and then transition into some of the TCFD work that you all are focused on.
Sure. Yeah, no, thank you. Thank you to the great work that you're doing and NAIC. Thanks to Commissioner Andrew Mais and everyone in Connecticut for your leadership, not just for hosting today's virtual conference, but for everything you're doing to educate insurance companies and individuals and taxpayers and legislators and everyone else, and to my fellow panelists for the great work that they're doing. So again, my name is Stephen Rothstein. I'm the managing director of the Ceres Accelerator for Sustainable Capital Markets. And Ceres has been around for over 30 years. And we do a variety of things, work with investors, companies, policymakers for investors. Our investors are collectively, it's about $60 trillion of assets under management, including a number of insurance companies, but some of the largest companies, BlackRock, State Street, Vanguard, investors, and others. And people come to us to help move their portfolio to be sustainable. That most investors today believe that that when they're in, the people who invest in their funds or their pension holders or retirees, when they want to get their money out, whether it's in 5 years or 50 years, that thinking about climate issues will help their return. It'll help in two ways. First, to address the risks that exist as investors and the opportunities. And as Stacy said, on the investment side of the house, that the insurers are a critical part of that. So there are some insurers, when you look at their investment portfolio, they're addressing climate issues and have set net zero plans, and some have not. We work with lots of big companies, policymakers in Washington and many state capitals, and then the financial markets per se. And the accelerator focuses a lot on the financial markets and boards of directors. We talk a lot about climate risk, and those are right with us every day. I've been doing this type of work for a while, and it used to be where you talk about it, this is a risk for your kids, your grandkids. Well, as we've seen from what's happening, this is a risk for us today. The storm that recently passed, while we don't have the final economic numbers, there are some studies that say it'll cost $50 to $60 billion. To put that in context, NOAA said for last year, take all of the climate events, the fires and the floods and the storms, hurricanes, et cetera, from 21, that was $145 billion of loss. And that was higher than it had been in other years. And if this year one storm is 50 or 60, unfortunately, we're heading in a trend. There's a lot of cost. We've seen that in Florida, just with this, even before this recent example, their state legislature put up roughly $2 billion to further backstop their reinsurance industry because of the risks there. So this is a climate issue, but it's really a financial issue as well on that. While climate is a critical issue, as I was saying, another one that we can't lose sight of is water. And I don't mean just a hurricane and flooding, the lack of water. That if we were on the other side of the country or in many parts of Europe or many parts of Asia, that we're seeing historic droughts, droughts that we haven't seen in 1,200 years, that there are many states now that they're on an allocation because of Lake Mead or others, where their water usage has been reduced by 20 or 30%. That's going to affect businesses, it's going to affect farmers, it's going to affect pricing, and that's going to grow. Obviously, water is a very precious resource, but it's also very local. So you could be in an area with a drought and 100 miles away, they could have it, but it doesn't really do much good. So we have a whole water initiative that if someone's interested, they could reach out to series, ceres.org. And we can share links as well. We have an investor network on this. We have companies that have been leading on these water areas, so that water and climate are both parallel challenges. The insurance industry, through the NAIC, has been collecting climate data for a while. They've just decided to replace the questionnaire with TCFD based, which is great. And again, I appreciate all the work that the comments that Stacy said about this, so that for many of you who are insurance companies, you're having to complete a TCFD report and submit it by November 30th. If you've already submitted it, that's great. If it's the first time, there are a lot of resources. They're on the series website and the NAIC website. We, for example, are sponsoring 10 hours of interactive discussions. 6 have occurred so far, and the other 4 are happening later this month. And I will again share the link with our colleagues in Connecticut for them to share with you. But that is a first look at some of the portfolios. You know, TCFD will ask every company, including the insurance company, to what are the key issues in governance, what are the key issues in strategy, in milestones and other key areas. And it's been used now by over 3,000 companies. There are 8 countries that require it. Plus, it's estimated that somewhere around 400 insurance companies will be completing it. So that's an important step that I will that we're happy to work on. I guess the other thing I'll just say before Jeff turn it back to you, and I'm happy to provide more background on any of this, is while at the parallel level, it's important to keep in mind that the Securities and Exchange Commission, they're currently considering a climate disclosure rule. So as many of you on this webinar know, they issued a proposed rule in March. They collected comments through June. They got over 14,000 comments. 80% of that comments were positive, not unanimously positive on every element, but generally directionally positive, but very strong on both sides. There are very strong opinions of people saying this goes too far for the SEC, either the broad issue or some of the specific areas. So the SEC is right now in the midst of considering this. It is likely they will have a final rule late this year, early next year. That obviously will only affect the publicly traded companies, so a small percentage of those who are watching now, but it'll also set a benchmark for others. So that's an important element. And they also have used TCFD as a basis. So one of the key things is to have as much alignment as possible. And I know that the international groups, the International Sustainability Standards Boards and others, and then the national groups like the SEC are just as NAIC did with its work. So Jeff, let me turn it back to you, and I'm happy to talk more about that or the other research we're doing.
No, thank you, Stephen. And yes, I mean, I think we'll come back here after Suzanne has a chance to walk through her comments. I did have a couple of follow-ups with you as well, and it is interesting to see. You didn't dive into the details on this, but on the water initiative, I'm kind of curious around the overlap around water infrastructure, or maybe some of the stuff that Stacy had highlighted. But we can come back to that that she had highlighted on the infrastructure side. So. But our last panelist here is Suzanne Scatliff from AXA XL. And Suzanne, we just heard from Stephen around TCFD. But of course, that's not the only disclosure that's making its way into the finance and insurance sector. So maybe you could talk a little bit about TNFD.
Yeah, of course. Thank you, Jeff. Happy to. I do have a few slides, so I'm just going to share those now. So thank you, everybody, for allowing me to join your panel today. I'm Suzanne Scatliff. I'm the Global Sustainability Director at AXA XL. We are the Property, Casualty and Specialty Risk Division of AXA Group, providing commercial insurance and reinsurance products globally. I'm going to talk to you today about nature-related risks and reporting. Both AXA XL and the wider AXA Group are quite heavily involved in looking at nature protection, but also the resilience benefits that nature provides us, which of course is very material to us as an insurer. So I'll start a little bit with some context as to, firstly, why it's critical that we start to consider the economic value of nature more deeply. I'll talk a little bit about the work that AXA XL have already been doing, and then I'll focus more on the emerging nature risks framework that's been developed by the Task Force for Nature-Related Financial Disclosures, or the TNFD. So to begin with, in terms of why we need to value nature, so we know that nature brings enormous value across supply chains and operations, as well as obviously providing many significant benefits to wider society. But to date, we haven't been great as a world in terms of actually putting the financial value on nature. That being said, there have been some recent studies. So I wanted to share with you a very recent study actually that was released just a couple of weeks ago from Moody's, which states that almost $1.9 trillion is at stake as biodiversity loss intensifies nature-related risks, which is just staggering, obviously. And although financial markets are currently under some strain at the moment, and perhaps biodiversity isn't immediately top of mind, Moody's states in their report that the long-term ramifications of a compromised natural world are significantly quite devastating. We can also see here that certain ecosystems or certain pollinators, for example, have an enormous role to play. And actually, if we see them significantly depleted, it's going to cost the world a significant amount of money. So if we lose our pollinators, you can see here an EU-funded study suggests it would cost us around 153 billion euros. And then very significantly for us, again, as an insurer, is looking at actually the green infrastructure that we have and the value that that provides. So mangroves, which we are very passionate about at AXA XL, as I'll share more shortly, provide huge flood resilience benefits. If we lost our mangroves, we'd be looking at a real significant amount of property damage, but also a compromise to communities who depend on coastal health in order to live and in terms of their livelihoods. This statistic here states that if we would see an annual loss of $65 billion if we lost all of our mangroves, and at the moment they're currently protecting more than 15 million people, so pretty significant. I wanted to share a little bit now about the work that we've been doing so far in terms of valuing nature before getting on to the TNFD. So we've had a long commitment to focusing on nature protection and that intersection with risk and resilience, as I mentioned. We've had a particular focus on ocean research, and we were really pleased to launch at COP26 last year our Coastal Risk Index, which is a tool which essentially shows the value of ecosystems. So we can see current and future flood hazards, but also the role that coastal ecosystems play in a way to start valuing the benefits of these natural solutions. We're also working with the Nature Conservancy to look at how we can quantify the resilience benefits of coastal wetlands. The concept essentially is that we would develop a resilience credit, a little similar to a carbon credit, but essentially it would quantify the flood resilience benefits of a mangrove, for example. So investors could purchase this with a carbon credit or separate to. And then I was pleased to hear Steve talk about water. That's certainly something we're passionate about too. We do believe that water-related risks are undervalued and underappreciated. And so in 2020, we launched our Valuing Water program, which looks at how we can help our clients and wider businesses and communities really identify and mitigate a range of water-related risks and consider the economic value of water as well as the social value. In addition, we also have a number of investment and underwriting guidelines, particularly focused on deforestation and World Heritage sites, really to think about how we protect these ecosystems and also prevent any kind of further damage or compromise to the value that they provide to us as a society. So I said I'd talk a little bit about the TNFD. The reason why I'm here talking about the TNFD is actually AXA has been a founding member and a very active supporter of the development of this disclosure and framework. Some folks may be aware that the TNFD is very much a global initiative. It's cross-industry. So there are a number of businesses involved. You'll see here on that third bullet point, some very significant companies and brands who are helping really build this out as a reporting framework, but also as a tool really for us all to better identify our nature-related risks and opportunities. The final recommendations are expected in September 2023, but there are a number of iterations, 2 of which have already been released. The next one is due around November time, and then the 4th version will be following hopefully in February. So you'll see here at the bottom of the slide, the first version essentially has focused on concepts and definitions, and I'll talk a little bit more about definitions shortly. It also includes some initial guidance for corporates to assess their nature-related risks, and also the draft disclosure recommendations, which are a little similar to the TCFD, and we'll look a bit more at that shortly. The second version builds upon what we saw in version 1, but it also includes a draft of metrics and targets, which of course is one of the key challenges when we're thinking about the quantification of nature, but imperative that we get it right. It also includes specific guidance, and that's both from a sector-specific side of things, as well as specific guidance related to certain elements of nature, which obviously will be more or less material according to the industry that the report is being provided from. So I said I'd talk a little bit about definitions. So we need to start obviously with the definition of nature itself. The TNFD has decided to use IPBES as the kind of guiding definition, which you can see here. But I also just wanted to highlight that for the TNFD, the fundamental concept is that people and societies interact with nature and cannot be considered as being separate from that. So a lot of what you see here, particularly on this diagram, but also throughout the framework, keeps that top of mind. The TNFD believes that nature can be understood through 4 realms: land, ocean, freshwater, and atmosphere. These are obviously major components of the natural world, but can be a little bit different in terms of their organization and their function. And you'll see that atmosphere here is included, but in a slightly different lens. That's really to kind of highlight the climate and nature nexus, and really acknowledging that climate mitigation and adaptation occurs across all of the realms. In addition, we also have definitions of nature-related risks, which I'm not sure how clear the slide is. I know there's quite a lot of text here. Hopefully we can make these slides available afterwards as well. So for those who've maybe gone through TCFD, you will probably recognize the first 2 categories, physical risk and transition risk, and I've probably been thinking about these through a climate lens. The proposal now is that we think about this through a nature lens. You'll also see systemic risk. So systemic risk essentially is looking at how we think about all of these things coming together. So actually, how can physical risk and transition risk potentially collide and cause a chain of consequences? So this isn't just about individual factors, it's actually thinking about a range of things coming together that could cause a systemic impact, either on supply chains or on operations. In addition, the TNFD have also included something very similar in terms of nature-related opportunities. For the sake of time, I won't share that today, but this is all available on the TNFD framework website, which I'll share at the end of the deck. So I wanted to just close now with the disclosure recommendations themselves. As I mentioned, for those who have been through TCFD or are familiar with the framework, you will recognize these 4 buckets certainly, and some of the structure is quite similar as well. So governance essentially is looking at organizational oversight. Again, as per the TCFD, that's both thinking about the management role, but also how the boards are involved in governing nature-related risk and opportunity. On the strategy side, we're looking at how nature-related risks and opportunities impact business model, strategy, and financial planning. Risk management, again, very similar to TCFD, looks at how nature-related risks are built into overall risk management approaches. And metrics and targets looks at key performance indicators related to nature-related risks and also opportunities based on nature dependencies, which the TNFD essentially identifies how an organization is reliant on a particular ecosystem or a particular element of nature, as well as nature impacts. So This is guidance for all sectors, but we do expect specific guidance for individual sectors to follow in due course, the same as the TCFD, where we have sector-specific guidance for these 4 elements as well. And the idea is that preparers should really be thinking about what's material, and that should be based on an assessment of nature-related dependencies and nature impacts. They should be considering how their organization interacts and interfaces with nature at specific locations. They should be thinking about how the correct skills and competencies are available to assess nature-related risks, and also should include a statement regarding the scope of current disclosures and what further disclosures might be planned in the future. So for those, again, who are familiar with the TCFD, I'm sure you know that originally it was developed as a voluntary framework, but actually we're seeing a number of jurisdictions adopt this as part of their own regulatory requirements. From a corporate perspective, I would say having this consistent approach can be very helpful. It enables us to focus on developing very detailed and robust, but also very focused reporting. Hopefully there is an opportunity for regulators to consider how the TNFD recommendations could be adopted in a similar manner. Of course, the final recommendations are yet to come, and we'll see further iterations, as I mentioned, over the next 6 months or so. So to close, a lot of the diagrams and the content I've shared today is all available publicly at this website address. The iterations that I mentioned will also be added in due course. So I'd recommend anybody who's not yet familiar with the TNFD to take a look. It's very user-friendly, and it's a great way for being prepared for what's coming down the track when it comes to valuing nature. Thank you for listening.
Thank you, Suzanne. One sort of quick follow-up for you, and then maybe I'll pose something to the rest of the panel. You know, I appreciate that you connected back to the TCFD in kind of how you think about the TNFD, right, and the similarities there. I guess I'm curious, what has sort of been the insurance sector's engagement here? And I you know, as Stephen had mentioned too, I mean, recently within the NAIC, they've moved to, you know, this sort of TCFD overlap, and that was quite a bit of a process to kind of move through that. So I'm just trying to think, you know, as you think about TNFD and, you know, what the insurance sector engagement is here, and how should maybe regulators, particularly in the U.S., be thinking about this new disclosure framework?
So, I mean, from an insurer's perspective, obviously, I can speak for AXA XL. I do know that a number of our peers have already produced TCFD reports, though. So, I think for us, we consider the TCFD framework to be a very useful tool. There are still elements of it that need to be developed further for the respondents. So, I think, you know, one of the tricky parts is on the metrics and target side. I think many carriers, including ourselves, have managed to develop a approach to calculating our carbon footprint from an operational perspective. There is now work underway for us to think about that on the underwriting portfolio side. So actually, how do we develop a decarbonisation pathway for underwriting? And the audience might be aware that the Net Zero Insurance Alliance is essentially a consortium that is working on that complex but important problem now to help carriers have better methodologies to work through that challenge.
Thank you, Suzanne. So a question for everyone, and you can figure out who wants to answer first. But I mean, you all essentially highlighted a number of tools and frameworks that are applicable or currently being used, and really, you know, from my perspective, a lot of these are fairly new. So I'm just wondering, kind of, what are you seeing in the application of these tools or frameworks? And in particular, you know, what is it that you're seeing or learning that would be, you know, especially relevant for regulators in the U.S. to be thinking about?
Do you want me to start? I'm happy to.
Absolutely. Go ahead, please, Stacey.
Sure. So one of the things I think that's important to you know, state is that TCFD and potentially TNFD and, you know, the kind of efforts around disclosure are really about solving an information asymmetry problem. And one of the kind of groundbreaking things that TCFD has done, I mentioned, is this common language, but it's also been a nice framework for entities, whether you're an insurance company or a business, or a corporation, to start getting your hands around climate-related risks, because you can't actually disclose anything that you haven't worked through. And this paradigm that they have, governance, strategy, risk management, and metrics, is a nice way to break down kind of how do we actually, I'll put myself in the kind of position of an entity that might be regulated by an insurance regulator. How do I, as an insurance company, understand how I'm governing around climate-related risks, what my risk management is around climate-related risks, and from there, the different hazards that I might be underwriting, what my metrics and targets are around measuring and monitoring those risks on an ongoing basis, and how that might feed into my strategy, my business strategy, my market strategy, the customers I serve strategy. So that framework has given people the ability to start rolling up their sleeves and figuring out how to identify, assess, and quantify risks that they might have that are of a climate nature. From a regulator's perspective, the disclosure is really important so that a regulator can understand the systemic exposure that the collection of entities that you're regulating might have to certain kinds of climate risks. But disclosure and reporting is only one part of the financial system governance body's toolkit, right? From a federal level, the financial system governance bodies are policymakers, they're rulemakers and standards bodies, and they're oversight and supervisory bodies. And they do not just disclosure, but they also do fiscal and monetary policy. They also do prudential kind of management, and they also do standard setting. So the disclosure among insurance companies to essentially disclose to regulators this, let's call it health check of what kind of climate related risks they might have, will be useful for regulators to then also start to plan how they might adjust to certain types of things. And by the way, this issue of the protection gap is a very important public policy issue, because if we do not have kind of the tools to help the folks who are most vulnerable, and I don't mean just the physical tools to help them build in resilience, but also the financial tools like insurance, all this comes back to the public balance sheet anyway. So from a policymaker's perspective and from a regulator's perspective, that information that you get from the disclosure is important to help inform how you're going to help address market issues, market failures, potentially think about how that protection gap needs to be served. There's some very difficult, from a physical climate risk perspective, there's some very difficult public policy questions on the horizon. Fort Myers is kind of our latest example of a big acute disaster where we have at some point, not that far in the future, to think about rebuilding. And the whether and how to rebuild is an important public policy question if there's no financial support for that. So from a big picture perspective, the regulators kind of should be looking at TCFD as a way to get information for them to do their jobs around, policy making, rulemaking, standard setting, oversight and the like, because this can be a systemic issue. And then I'll just say, as it relates to the nature side of things, the industry has perceived climate-related risks to be very asset-based, but actually part of our resilience is the nature that we protect. And those tend to be very public policy, objectives as well. I mean, you save a mangrove or you protect the Chesapeake Bay. I'm sitting in Washington. You protect the Chesapeake Bay in order to protect the communities upstream, right? And so these are all part of a kind of comprehensive way of building in resilience, for all of us.
Stephen, I'd like to pass it to you on this because, and maybe I don't know if you were going to go here based on Stacy's response, but yes, I would agree there's a lot of information there, but I think even some of our own work, the challenge is how do you work through all of that information? And I know Ceres is involved in, it's sort of an initiative around that, but maybe you were going to speak to that, but I would kind of pose that question to you from that, that perspective.
Sure. Yeah. Let me get to that in just a second. First, I agree with everything that Stacy said. And for a company that's doing it for the first time, two things. I wouldn't let the perfect get in the way of the good, meaning you're not going to have good information. And I've read now several companies, not insurers, who have filed TCFD 3-4 years. And the reality is every year it gets better because their systems get better. And the first year they may not have a committee to address this. They may not be collecting information, and next year they do. So don't let the don't let it get in your way. The second thing is that we all, as in any whatever business we're in, we can't manage any problem if we can't first measure it. So, but measuring it does not mean managing it, meaning disclosure is critical. And as you mentioned earlier about the asymmetry of information, we have to make sure that investors, whether those investors are insurance companies or others, have that information, but also that these are public, and this is for employees. 74% of employees want to work in a place that upholds their values. Every company, whether you're an insurer or in any industry, we're all looking for employees at this stage of the marketplace, so that's important as well. So it is a critical element, but it's just the first element. The second element is then to develop a plan to reduce exposure, reduce admission. One of the things that we're doing with California Insurance Commissioner, NAIC, and others is to do an analysis of machine learning. So it's impossible to have a human being read all of the TCFD reports and then to do a summary of those, just in terms of bandwidth. But what we do have is a company based in Europe, but they're focused on natural language, the machine learning. And so we've analyzed all of the 21 TCFD reports in the final stage of the review now, and analyze them to see who has specific recommendations, which ones are more general. And it's not going to grade them, but at least there'll be some information that'll be available on the series website and California and others. So that's an effort that is going on, and that's likely to be expanded with the 400 that'll be submitted on November 30th. So back to you, Jeff.
Yeah, no, thank you, Stephen. I mean, that's kind of what I was getting at in my question there, and I would agree. I mean, I think it's very difficult to work through all that information, right? And so, maybe this is sort of the next phase in the climate front. I don't know, is trying to, first it's collecting the information, but then trying to develop tools or other aspects that can kind of help work through that a bit more effectively and efficiently to try to, Stacey, to your point, to make some policy or regulations around that. Suzanne, I don't know if you had a comment on any of the tools aspects. I mean, you did mention the coastal risk index or other things related to the TNFD, but I'm just curious, is anything that you're seeing on the tool side or what you're learning from the implementation of these?
I mean, I think climate tools are relatively mature compared to nature. That's the key challenge, obviously, that we're seeing now is that nature still feels very nebulous. There's been some interesting academic papers produced by NGOs, by governments, in terms of how we need to rethink GDP, for example. But what we need now is something that's translatable from a corporate perspective. Some of the statistics I shared, obviously, are those kind of global macro level. But actually what we now really need to get down to is, rather than the global impact of mangroves, actually, what about this particular mangrove forest in Miami? How do we quantify the financial benefits of that? What are the financial risks if we lose that particular mangrove forest? So that's the next frontier for us, is actually taking a more granular approach to how we value nature, and then building that into products and pricing, and also helping our clients better understand the fragility of their supply chains. I think we've seen that to some degree with things like the global pandemic and the impact that climate is already making, but that will continue to happen. And we need to get really smarter as a world in terms of how we value nature and think about it in the same way that we do some of our other commodities.
Yeah, I mean, I think that's a good point, and reminds me of there's been some work through the IAIS and their GMAR report. I can't remember their exact acronym on that, the Global Monitoring Assessment Report that they have for the insurance sector. And they had ran a climate transition risk analysis, but it was a sort of a global framework methodology that they had proposed. And so as even we've started to think about that, and maybe getting that more granular, like you are stating, Suzanne, down to sort of the U.S. level, some of these methodologies that work from a global perspective might not translate necessarily as you move into the more granular aspects. I think that's it's kind of a good point. So I'm going to turn it over to my panelists if they have any final thoughts or comments before we close.
Yeah, Jeff, actually, I was going to chime in on your last question about what to do with all this information from your perspective, right? So this information is going to come fast, and it will be really useful for you to think about how, how as a regulator that affects kind of your own little system that you're managing. And that you're kind of minding as a regulator, but kind of taking it one step further, which is where I think kind of saw, this protection gap issue is, but also potentially how a better understanding of climate-related risk can lead to certain incentives in the system, right? So if you can have this disclosure, you can have this information, you understand how this might start to affect kind of the entities that you regulate, then you can start to say, well, what are the things that we might need to put into the policy-making body, the financial policy-making bodies to, incentivize climate resilience, for example. One thing that insurance companies do in other parts of the world is they are starting to price around this resilience. So your risk-adjusted cost of insurance, again, for certain types of coverage, certain types of hazards, can be differentiated if you as a purchaser of that insurance are doing the right things to become more resilient. We haven't in this country made those connections yet, but it could be actually quite important, particularly thinking about Fort Myers and how we rebuild after Fort Myers. If we do, what types of rebuilding? Certainly the current standards may not be sufficient, right, for that particular piece of land and geography. But the other thing that insurance can do, if not pricing and incentives for resilience, it can also potentially start to discourage maladaptation. And that's also part of insurance's DNA. It already does risk-adjusted costs and pricing, but I think that because insurance companies are just starting to figure out and get their hands around some of these risks, maybe we're not seeing as much of that maladaptation kind of question as well. But I think that's kind of maybe for another panel or another session.
No, as an economist, I certainly appreciate your comments around incentives. So thank you for those closing thoughts. Stephen.
Yeah, I mean, there's a lot been said that I think bears repeating. I will add one other point that was briefly alluded to or mentioned before by Stacy, is that, well, this affects all of us in society. It affects mostly more directly those of our neighbors that are low and moderate income. We have to have specific projects and specific products to meet those needs. I'll turn it back to you in the interest of time.
Suzanne, any final comments or closing thoughts?
I guess maybe I would just add that I think, we're probably more aware than ever how interconnected our world is. And I think we need to continue to think that way, particularly with both policymakers and the private sector. I think, again, staying on nature, we've got an enormous opportunity to be smarter about how we think about natural capital. We need to move as a world from thinking about it being free and infinite to actually being limited and expensive. And I think, we've all got a role to play together, both policymakers, private sector, public sector, society at large, in making sure that actually we get smarter, quicker about how we actually value nature.
Well, thank you very much to all of our panelists. I mean, I think that, sort of this notion of awareness, or the fact that, and I can't remember which one of you said this, but all these tools that are being developed, and they're really sort of in their infancy, relatively speaking. And so, it'd be interesting. It's going to be interesting to see how these continue to evolve, and maybe we'll come back next year and talk about that. So thank you very much for your participation.
Thank you, Jeff, and thanks to the folks in Connecticut.
Hey, everybody, it's Chris Murphy, U.S. Senator from Connecticut. Thank you to my friends at the Department of Insurance for putting on this really important climate change conversation. As a coastal state with much of our most important infrastructure located on Long Island Sound, the rising sea levels, the increased pace of ferocious storms matters more to Connecticut than many other states in the nation. And so we have to be serious about the costs to Connecticut, the costs to property owners and ratepayers in Connecticut of failing to step up to the plate and reverse the impacts of climate change. I'm glad that you are thinking about the intersection between insurance policy and climate change policy, because there's no way to pull those two conversations apart. I do have some good news for you as you convene this conference. Congress just passed the most significant climate change legislation ever, and it is going to expedite the work of converting our economy from a fossil fuel-based economy to a renewable, green energy, clean economy. That's great news for Connecticut, because a lot of the companies that make that technology, whether it be advanced batteries or fuel cells, they're located in Connecticut. But it's also great news for us because it will reduce the pace of sea level rise and the pace of climate change. That will, I hope, help actuaries and help insurance companies have a little bit better sense of what the overall cost is going to be for a coastal state like Connecticut. This is a moment for us to briefly pat ourselves on the back, having finally gotten over the hump and passing major climate change legislation that will reduce climate emissions by 40% over the next decade, but also a moment to recognize that we have a lot of work ahead of us. And Connecticut has led the way with really strong state policy. Now you finally have the federal government as a partner, and I look forward to being in conversation with the insurance industry about how we can better coordinate smart climate change policy. Thanks for inviting me to say a few words.
Good day, and thank you for joining our industry conversation on climate risk and reporting. I'm Kathleen Borain, and I serve as the Maryland Insurance Commissioner, and I lead the solvency workstream of the NAIC's Climate and Resilience Task Force. Even before the devastation caused by Hurricane Ian, climate and weather-related risk and resiliency have been a major focus of policymakers this year. And one particular area of focus has been on disclosure requirements, including the NAIC's release of its revised TCFD-aligned climate disclosure survey and the SEC's proposed climate risk disclosure rule. Our discussion today will focus on the intersection of climate risk assessment and analysis and climate risk reporting requirements, and specifically where disclosure requirements are useful and drive meaningful analysis, appropriate action, and the distribution of valuable information, and frankly, where they do not. Our panelists today are each immersed both in the policies and the practicalities of addressing the impact on changing climates and weather on the insurance industry. From the company perspective, we welcome Dr. Kelly Herai, the Director of Catastrophe R&D at Liberty Mutual in the Corporate Enterprise Risk Management Group and a board member of the International Society of Catastrophe Managers. Dr. Herai is a certified catastrophe risk management professional and specializes in climate change and emerging risk. From the Hartford, we are joined by Terrence Shields, who serves as the head of corporate law and is the assistant corporate secretary. Mr. Shields currently leads the legal teams dedicated to securities and corporate governance, ESG, mergers and acquisitions, and intellectual property. And he recently assumed the role of interim chief sustainability officer, leading the Hartford's Office of Sustainability as it supports ESG strategies, initiatives, governance, and reporting across the enterprise. In addition to our carrier representatives, we welcome Satyam Khanna, who is an independent sustainable finance consultant and the policy fellow at the Stanford Institute for Economic Policy Research. Mr. Khanna joined Stanford after serving as the SEC Senior Policy Advisor for Climate and ESG, the agency's first ever official dedicated to integrating ESG considerations into the federal securities laws. Previously, he was counsel to SEC Commissioner Robert Jackson and served on the staff of the Financial Stability Oversight Council at the U.S. Treasury Department. And from S&P, we welcome Dr. Paul Monday, a director, global climate adaptation and resilience specialist, and lead and coordinator of S&P global ratings, research and application of climate adaptation and resilience analytics. Dr. Monday works at the interface between data and research, leveraging his expertise to improve clarity of the credit impacts from climate risks. With experience in both the UK and abroad, Dr. Monday advises private and public sector clients across multiple sectors to help mainstream consideration of climate risk and resiliency into projects and programs. So with that esteemed panel, I think we can get started on what I expect to be a really rich conversation today. So let me start with the broad question of governmental climate risk reporting requirements, or at least in the case of the SEC, proposed reporting requirements, and ask you about the utility and, frankly, the feasibility of some of those requirements. Do these reporting requirements make sense? Do they provide valuable information? Can companies even provide what's requested? And Satyam, let me start with you. Can you give us a short summary of what the SEC is proposing? And then I'd like to hear from the group about how the SEC proposals align with other reporting approaches, such as TCFD, and the practicality and utility of these forms of government reporting.
Of course, and thank you, Kathleen, and I'm delighted to be here. So the SEC proposal broadly contains the following key provisions, and this is at a high level. First, it would create new requirements for the disclosure of climate-related risks and impacts. It would include a requirement to disclose in a company's financial statements certain disaggregated metrics on climate-related impacts. And then third, it would require the disclosure of a company's greenhouse gas emissions, which would include Scope 1, Scope 2, and Scope 3, and for all but the smallest companies, Scope 3 emissions. And just to provide some context, when I was at the SEC, we released a request for information on climate disclosure that helped lay the groundwork for the current proposed rule that you all are familiar with. And what companies and investors said in response to that request is that they are already doing a lot of climate-related disclosures on a voluntary basis, and they encourage the SEC to build on that foundation. So at a high level, and to answer your question, the climate disclosure rule builds on existing market practices. And what the SEC is doing is taking what's out in the market and codifying it in this rule, in particular, the familiar four-part disclosure framework of the TCFD, and for emissions disclosure, the greenhouse gas protocol.
So I'm interested if the companies agree sort of with the assessment that this is building on what companies are already doing, or does it sort of drift into areas that are beyond what companies are doing and maybe what climate scientists might tell us they can be doing?
So maybe I'll start there, because I think there are really two sort of big buckets of particular interest from the insurance side, right? So there's the emissions reporting, which, as you mentioned, some companies are already doing as part of their TCFDs, with traditionally more of the focus on Scope 1 and Scope 2. Scope 3 remains a challenge, and I think that's true both within the insurance industry and outside of it. But what was particularly interesting to me when I started looking through the SEC reporting requirements was this concept of disclosing physical risk. And this distinction between sort of the mitigation side, what's happening on the emissions side, and the adaptation side, what's happening in the physical risk space, is an area where I think insurance has a real opportunity to show up and have our industry be leaders in sort of framing that discussion, because of the expertise that we bring to the table of decades of experience looking at the extreme events that drive many of our largest physical risk impacts on our economy. So as you mentioned, my background is in catastrophe modeling, which we've been using for roughly 30 years to look at our most extreme events, meaning hurricanes, wildfires, floods, along with non-climate related perils, things like earthquake or terrorism. And one of the things that really struck me about that disclosure requirement is the requirement to disclose physical risk down to the zip code level. And the reason why this was really interesting to me is that this has struck me as a particular challenge in reporting physical risk on the investment side of the house. And this is an area that we've seen pop up as an area of concern, both within the US as well as internationally in reporting requirements, is that typically the information that we have available about our investment books is much more limited in just the physical locations of assets and the characteristics of assets that we would typically include if we were to write them as an insured risk. So for example, in an investment, we might know that it's based in the US, but if we were to write it as an insurer, we would know the locations of every one of their 1,000 retail locations and details about their construction characteristics. And the reason why that's important is that within sort of one country, you're going to have very widely varying physical risks that you're subjected to from climate change. If you're in Miami, you need to think about hurricanes. If you're in California, you don't need to think about hurricanes, you need to think about wildfire. If you're in Minneapolis, maybe you're thinking about flood risk. So the risks that you are subject to vary depending on where you're located, and we don't have that level of granular information today. So from that perspective, just knowing where stuff is a real upgrade. However, I think it's also worth noting that the detail of information that we can pull out from the climate science side down to that level, so on the hazard side specifically, is going to be a real challenge at that granularity of geography. So I recently was at a sort of a strategy workshop with a bunch of different climate scientists who are trying to think about, like, where do we invest our scientific resources to be able to better answer questions that are being posed to us as a scientific community. And I got up in front of that group and I said that we are now being required to report physical risk down to the zip code level. And there was an audible gasp in the room when I said this, because climate models actually work better at sort of large regional scales. That's not to say that we can't pull detailed information out of climate models, but we need to tread really carefully and respect sort of the distribution of uncertainty that those models produce at the spatial scale where reporting is going to be required.
Yeah, and I guess the way I look at it, I'm a securities lawyer by trade, so I focus in on the new rules from a perspective of materiality. And again, I think the SEC made a good decision to align much of its proposal with TCFD. I do think at the center of the debate and likely any litigation that emerges upon the adoption of the rules will be the notion of whether the SEC overreached, right? And the SEC is charged with investor protection. And what does that mean? That means providing material information to investors to inform their decisions, right? And so traditional notions defined in common law of materiality, simply put, is the information important to a reasonable investor in making an investment or a voting decision? And I think there's a really strong argument that how a company manages its climate risk, how it sets up its governance frameworks, its climate strategy, and related goals and progress are important to stakeholders and investors. If nothing else, it's a proxy for operational excellence of management teams and boards, which in and of itself, I think is important to stakeholders. So aligning with TCFD made a lot of sense to me. I think where the challenges will emerge is perhaps where it overreaches a little bit as to that materiality concept, and then some feasibility concerns, right? So you think about, the attribution problem, whether a particular loss or potential loss is attributable to climate change, or is it attributable to just normal weather patterns or overpopulation, in a wildfire prone area, or poor land use planning. The SEC rules imply that we would have that level of granularity to ascertain what is attributable to climate change versus perhaps other factors that could also be contributing to the loss. And then they attach a very low threshold to disclosure. There's a 1% threshold for each financial line item. If you could foresee a financial impact of 1%, that triggers a disclosure obligation. To me, that's hard to argue materiality at that low a level. And then as I flip to kind of some of the emissions reporting, on scope 3, which would require that we disclose emissions of all of our customers and investees, there's massive data challenges associated with that. Our investees, our customers, they don't report this, by and large, report this information, but we have a small commercial book. Mom and pop shops aren't necessarily reporting that information. And so how do we get at that data in a reliable way to make that information meaningful? And so I think there's real issues with that. There's developing standards on how to measure emissions for scope 3 that are not fully mature and ripe, certainly on the underwriting side. And so again, to attach a disclosure obligation to something that has not fully developed and then an attestation requirement on top of that just adds a lot of potential exposure for insurers and really I question whether it's decision useful information for investors.
Yeah, if I'm, if I were to put on I'm sitting in the SEC seat hat, I would say, well, the disclosure requirements the requirement will cause that disclosure to move forward. The ask itself is going to produce more data. And I think there are some cases where you can reasonably argue that that's the case, right? Disclosing where your stuff is physically located. To me, people aren't asking for it today. If you start asking for it, it will be produced. But I think we also need to be careful about where the ask itself will cause data to be produced when perhaps that data may not necessarily be meaningful. So I go back down to that resolution problem again. And this is an area that the insurance industry has a lot of experience thinking about this problem of what granularity of data is useful and meaningful, because we have to manage very large geographically distributed risks down to the location of individual buildings. So we bring some unique insights to this problem. But I think that sitting in sort of the large company side, and I think my peers who are in a similar position will make the same argument, is that there are immense numbers of climate data analytics providers that have sprung up partially in response to regulatory requests, offering to sell climate related data in a packaged form so that you can say, I'm going to look at my book and it's going to produce a number. The problem with this environment is that there's a lot of churn and there are a lot of new players who are participating with, I would say, widely variable levels of expertise and knowledge in this area. And our ability to sort out who is producing useful information versus who is producing less useful information may not always be immediately apparent. Because remember, we're trying to make projections out in sort of the decade to 30 years time frame, which means that it may be a while before we can sort out who is producing good climate data and who is producing garbled nonsense data. There may not be an obvious mechanism for the market to correct for disinformation in the climate services space for some time. So we run the risk, if we don't have people who sort of can serve as this climate translator function, who understand sort of what is scientifically feasible and who understand sort of the impacts of the financial sector, we run the risk that we're going to generate this very large churn of data that is, in a sense, maladaptive. It causes us to make decisions that in some senses can make the risk worse because we don't have good information that's available at the table. So making the ask can help to foster innovation, but we also need to have some controls and guardrails in place to make sure that the ask is still within the realm of the feasible or the scientifically defensible today. I think there are some areas where it is certainly, coastal flood, we can get down to a great level of granularity with reasonable sea level projections out to the timeframes that we're discussing out through 2050 or so. But our ability to get very granular information about regional changes in rainfall or extreme events like hurricanes is still very much developing science and really still is at the cutting edge of the climate science community today.
No, I mean, that makes perfect sense, right? I mean, thinking about where do we need to align the ask with where valuable, accurate, real information can be acquired and it can be evaluated and reviewed. But also, I think we have to think about it in terms of where we want to put bandwidth and where do we want to put focus and what is actually ultimately valuable, because chasing data for the sake of chasing data isn't a particularly valuable exercise for anybody. So as we think about what is it that, in the context of the SEC, what it is that investors should really need to know, what is material to their decisions. But then, more broadly with other governmental agencies, as we review these disclosures for other regulatory purposes, solvency considerations, et cetera, what do we legitimately and realistically need to know? One of the things that I think you said, Dr. Harry, that is, I think, important, looks at how do disclosures requirements impact behavior. So how are they utilized to drive certain behaviors? And one of the concerns that sometimes is raised about climate-related disclosures, including the ones that are proposed by the SEC, has to do with what may be a focus on transition risk, and perhaps even a desire or an expectation that insurers will pivot away from certain kinds of industries, both in terms of investment in those industries and in insuring those industries and products. And there's really quite a lot of conversation around does that pressure exist? Is that ever a good thing to pivot away in that way? What is the sort of the glide path with respect to this? I'm interested in hearing your thoughts on that issue.
Yeah, and we actually were confronted with this issue head on recently in the shareholder proposal arena, where we received a proposal effectively asking us to stop underwriting companies that engaged in any exploration for new fossil fuels. And so, despite the fact there's wide recognition that fossil fuel companies are high emitters and are contributing to climate change, I think it's important to understand that we don't have a turnkey solution as we sit here today. It's not a cold turkey approach doesn't work. The world's going to need energy. This is referred to as an energy transition for a reason. So really, the notion of kind of choking off that industry or pivoting away meaningfully from that industry, not only is it unworkable, but it also, in my view, runs counter to an energy transition. The reality is those fossil fuel companies are going to have to be participants in this transition, and many are in the best position to impact that transition from an infrastructure perspective, from an expertise perspective, from a scale perspective. They have the greatest ability to influence outcomes in this arena. So, when we received that shareholder proposal, it offered us an opportunity to outline, what our commitment to energy transition means and how that would manifest, and how there are flaws in really a divestiture-focused approach. And so we had actually recently declared for net zero by 2050, and it was really important for us to let our stakeholders know what that meant and what it did not mean. And for the Hartford, being a net zero company doesn't mean we're going to abandon hard to abate sectors. We're going to hold them accountable for progress, much like we're going to hold ourselves accountable for progress. But those companies, again, have to be participants, and kind of abandoning those sectors, in our view, is not going to help our society get to net zero. And it's not going to help the Hartford as we balance our climate goals with our other obligations to create value for our stakeholders. So, again, as we kind of navigate this energy transition and our kind of role in it, and how we interface with these fossil fuel companies, I think there has to be a recognition that they play perhaps one of the most significant roles in that transition. So,
I think it's also worth noting that we want to make sure that our good intentions do not drive unintended consequences as we push through towards the energy transition. So, for example, if you were to have two companies that are both producing fossil fuel related energy today, one of those companies is investing research and resources and people and talents into renewable energy sources. It's trying to transition its business model into something new and wants to be a major player in the new renewable energy economy. And then you have another company that is doing what it does really well, which is get oil out of the ground. If you say, insurance company, I am now not going to participate with either of these two companies, what you've essentially done is you have handed a competitive advantage to the company that's doing nothing, right? Because the company that's investing all of its resources into trying to do the right thing is not being recognized for trying to do the right thing. Now, is it easy to tell which companies are which? They're not necessarily. So, we're working with some partners to try to identify which companies have credible transition plans and which ones do not. But it shows that the easy answer of just divest from all parts of the economy that rely on fossil related energy would essentially require divesting from the economy. So we need to go at the energy transition with sort of a nuanced view that allows us to understand how our energy mix is going to change through time while holding accountable companies that are not doing enough. So I think we need to tread carefully in that area. Now, I do want to emphasize, though, that this is, again, an area where I think the insurance industry is uniquely well placed to look at sort of the flip side of the coin, right? So I think the reason why many of our disclosure requirements have been so focused on transition risk is because many of our disclosure requirements sort of stem from other parts of the financial sector where that kind of information is more readily available, when what insurance can uniquely bring to the table that perhaps other parts of the financial sector are not as well placed to assess is the climate adaptation part of the story. So there is climate change that is already here. It is affecting our risk today. We are seeing it impacting events today. There was a rapid response study in the aftermath of Hurricane Ian, which just hit Florida with devastating impacts, including a massive sort of inland flood footprint, arguing that hurricane-related rainfall in that storm was increased something like 10% as a result of climate change. Insurers are uniquely well placed to look at how climate risk can contribute to these major catastrophic events. And so the insights that we can offer on the change in hazard, and particularly how that change in hazard intersects with the built environment, are an area where I see that we need to step up and position ourselves in a leadership position that is a little bit different than our role on the mitigation side.
I want to, so just to respond, Kathleen, to you, and then to both Kelly and Terrence. So I want to stress a point about the securities laws in general that I think can be a bit muddled in debates about what this rule intended or didn't intend. And that is that, at least in the public company disclosure space, the SEC cannot itself regulate corporate conduct. And in this case, that kind of conduct which affects the environment. What the SEC cares about here, as with all public companies, is disclosure. Now, disclosure rules can certainly affect corporate conduct, but that's true for any securities disclosure rule. Terrence alluded to this, but I think the relevant inquiry about what is or is not the effect of these rules is what do your investors want? So I hope companies are engaging with their investors about what their fossil fuel risk profile is on these issues and so forth on these issues, and the investors' expectation for companies' management of these risks. But I must say the SEC, the securities laws are agnostic as to a specific regulation of corporate conduct. They don't do that. What the SEC is doing is requiring disclosure, and that's the beginning and end of the SEC's involvement in this space.
And it'll be interesting to see how that disclosure plays out on company behavior. I think we already see some evidence where disclosure is causing sort of large energy companies to think about what parts of their portfolio of energy production they want to continue with and which parts that they want to leave off. I guess the dilemma comes in that because not all companies are required to disclose this information, we run the risk of sort of our highest transition risk properties, so sort of our most carbon intensive fossil fuels, going into parts of the private sector where SEC requirements are not necessarily required, and into companies that may be less well placed to take on the long-term responsibility and liability associated with those assets. So, we need to be careful that, again, we don't cause sort of these unintentional dislocations. And, there's not like a good answer to that problem, but I think it's worth just, yes, the rules themselves do not require any particular sort of emissions profile, but they can incentivize behavior that in some cases may increase or displace risk in ways that are hard to track.
Yeah, and Satyam, I totally agree with the notion of talking to your shareholders, and I guess that is what generally informs my view that TCFD is well aligned, right, with materiality, because we talk to our shareholders regularly, and the types of feedback we get and the lines of inquiry we get from them really do focus around things like governance strategy, and goals and risk management practices. So I think a disclosure framework that is centered around that again makes a lot of sense to me.
Well, beyond governmental reporting, insurers also work with credit rating agencies, and credit rating agencies consider climate risk. So for today's discussion, I'd like to focus particularly on investments, and particularly on investments in infrastructure and adaptation. On the one hand, insurers have a unique perspective, skill set, and role to play in helping communities to identify and mitigate risk and to become more resilient, both as knowledge partners and as investors. But those may not be the best investments from a strictly financial perspective. So, how do companies and rating agencies look at this issue and sort of what could be an intersection, but also, contradicting points of view?
So I'm going to speak about how we see physical climate risks changing, the potential role of insurance in building resilience, and also some of the inherent challenges. So, first of all, it's really worth noting that, against this backdrop of an increasing focus on disclosure requirements and reporting by financial institutions, the vulnerability of assets, companies, and also countries, of course, to physical climate risks continues to grow. And really, as global emissions continue to rise, the physical impacts of climate change are increasing with each passing year. And really, to that end, our sustainable finance team, we published a report earlier this year where we assessed the potential losses linked to the physical impacts of climate change globally under different future warming scenarios. And our findings suggest that about 4% of global GDP annually will be at risk of losses by 2050 if current pledges to reduce greenhouse gas emissions are put in place and achieved. Now, to kind of put that into context, this is more than the downturn that we saw during the COVID-19 pandemic in 2020, when global GDP declined by about 3.3%. So, in other words, physical climate risks could represent a COVID. In other words, physical climate risks could represent a COVID plus event each year without efforts to adapt. And the research really also highlighted the wide divergence in countries' vulnerability to these risks worldwide, really with kind of lower and lower middle income countries set to experience GDP losses on average about 3.6 times greater than wealthier peers. And we found that South Asian countries faced GDP losses of about 15% by 2050 per year, compared to about 1% for European countries and about 4% in North America. And again, that's under this kind of current policies climate scenario, about 2.6, 2.7 degrees of warming by the end of the century. So, of course, that's missing this well below 2-degree objective of the Paris Agreement. So under warmer pathways, there could be more losses, greater losses. And of course, the challenge isn't some future risk. We're already seeing that the US is experiencing increasing exposure to climate hazards, particularly larger and also more costly events like storms, droughts, wildfires, and flooding now. And indeed, NOAA, the National Oceanic and Atmospheric Administration, suggests that severe storms, hurricanes, flooding, they've kind of combined led to over 3/4 of the billion-dollar climate hazards that we've seen since 1980. And to kind of hit home on this point about kind of geography a bit more, those billion-dollar events are occurring all over the country, all over the US, suggesting that kind of irrespective of where you are, most parts of the country are exposed to some type of climate hazard. And therefore, the challenge for the US and other countries indeed as well could be significant without concerted efforts to adapt and to build resilience. Now, at the same time, it's become widely acknowledged that there's a gap in terms of the amount of finance that's making its way into funding projects that help communities and companies adapt and build resilience to the projected kind of increase in physical climate risks. And against that backdrop of increasing exposure to physical risks that I've just described, this gap could really grow further still, and it really kind of demonstrates the need for additional investments in adaptation. Now, for the insurance sector, it's similarly trying to kind of grapple with how to manage these risks, those associated with climate change. And from my position, sitting in our sustainable finance team, it's clear that the insurance industry is really very well positioned, with its access to data, to expertise, to try and assess those evolving risks. And that really enables stakeholders, governments, companies, individuals to make better decisions. Suffice to say, the sophisticated kind of climate risk modeling capabilities available to insurers can really help provide unique insights into policyholders' exposure. What we're also seeing is, property reinsurance also plays an important role in kind of building economic and financial resilience for those loss-affected policyholders after those loss events. And many reinsurers are actively looking to develop new products to kind of help them address this large and growing proportion of society that is underinsured. And you may have kind of heard that referred to as this kind of disaster protection gap. Now, that said, as losses from physical climate risks increase, insurers are likely going to react by raising prices or reducing their exposure. And we've already observed examples of both of those strategies in the US in recent years. And of course, suffice to say, higher insurance premiums or risks that are uninsurable may lead to a widening of this protection gap that I've just described. Now, the final point that I wanted to make really is kind of centered around some of the challenges. We know that physical climate risks are an exposure to those risks is kind of getting worse, but there are some challenges in kind of how we assess the exposure of assets of companies to those risks. And really, while we've been learning more about the physical impacts of climate change, including where and when impacts may occur, and we've got a bit more clarity about what some of the associated costs might be, there are challenges facing insurers, including those particularly associated with data, uncertainty, standardization of data sets, terminologies, etc., and also disclosures. And that really affects insurers' ability to leverage their core functions to address this adaptation gap. And many of those challenges, they can come in different forms, of course, but principally uncertainty is one of the main ones, and that really serves to kind of add to the complexity of the challenge. So when we think about adaptation, we're thinking about how some of these impacts may play out. The timing when these impacts will play out, but also the geographic scales over which climate hazards and their impacts play out are also quite relevant. At the same time, we have limited availability of data on the kind of effectiveness of adaptation measures. That's a relatively unknown. We're still gathering data. So some adaptation measures, like a seawall, for example, that may be protecting an airport against sea level rise or storm surge, that's likely to be extremely effective. However, the effectiveness rather of other measures, like initiatives that involve multiple actors, or those that take place over a long period of time, the benefits of those measures may be less clear, and they could play out over time. One of the last point on some of the kind of uncertainties, I think, relates to standardization. I mentioned terminologies of data, and also the kind of complexities more generally of kind of climate science. There are many different climate models, there are many different climate variables, and there's also an increasing number of data sets. However, there really is limited standardization between them, like the terminologies that are used, the data quality thresholds that are applied, and a defined set of use cases. How should you use this data for particular types of assets in different parts of the world? And the result, of course, is that uncertainty, and specifically the comparability of outcomes, is a growing challenge for the sector. That said, the increasing focus on standards and disclosures is trying to address this issue, but we know when it comes to adaptation, that adaptation tends to be context and place specific. So, it matters what you are and where you are, and therefore the interventions and the strategies that are needed are oftentimes unique, making the comparability within and across portfolios, across assets, a real challenge. Now, I'm conscious of kind of ending on a somewhat kind of negative note. So, I wanted to say that it's worth recognizing that there's been significant progress in this space, in recent years, understanding kind of risks and what we can do about them. And I recall a paper from a couple of years ago that counted about 370 or so climate data providers just in the EU alone. So there's more data than ever before. And with that context, while no perfect solution exists to how we might resolve the financial impacts of physical climate risks, this shouldn't be an excuse for inaction. And what is clear is that collaboration is necessary to kind of tackle these, in many cases, shared risks, and that the insurance industry will be a real key voice in that discussion. So I'm often asked, there's a growing interest in assessing and understanding the exposure of assets and companies to climate hazards, as well as disclosing any related metrics. And that brings with it some potential challenges and also some potentially, unintended consequences. And there are associated risks with that. And really, we've seen a lot in the literature, particularly quite recently, actually, in the last few months, commentators suggesting that the kind of rapid and in many cases unsupervised uptake of climate risk data could lead to a number of challenges. And what that literature is saying is that there's potential for unintended misuse in the context of financial decision making and disclosures if you're using data and not really understanding some of the uncertainties and some of the challenges associated with it, some of the assumptions. There could be misplaced confidence in the assessments of climate risks, and an increase in vulnerability of an entity to climate risks, where a particular assessment has said there may be low or no risk. There could also be resulting material misstatements in financial reports, and of course the associated potential for litigation, irrespective of the fact whether this is kind of an unintended misstatement, of course. And also maladaptation. We don't tend to talk about maladaptation very much, but maladaptation is really where adaptation backfires, and it really kind of serves to increase rather than decrease the vulnerability of an asset or in a company. And particularly in the case of long-term capital investments in infrastructure, which typically have operational lifetimes of multiple decades in many cases, maladaptation is a real risk, and there's a possibility that we could be setting ourselves up for even greater challenges in the future.
From a company perspective, I think we think about investing in two ways. One, we think about strategic investment in a way that better enables the Hartford to participate in the opportunities that global energy transition will create. And then we think about just pure play financial investing in infrastructure and other green energy initiatives. And really, we view both as playing a role in helping communities identify and mitigate climate risk, and both can support value creation. And we don't view those objectives as mutually exclusive in every instance. So, we approach the issue both from an underwriting perspective and an investment perspective. On the underwriting side, we're looking at constantly assessing our product portfolio and how we can invest in creating product enhancements and or new products. Whether that means investing in people and expertise or data or partnerships. We do think there's an opportunity for those who spend the time and allocate the resource to that type of investment for companies to to reap the rewards as the moment arrives. We've got, obviously, with the Inflation Reduction Act, $370 billion worth of green energy initiatives and infrastructure earmarked, right? And those initiatives are going to need insurance, and they're going to need the expertise behind risk selection and investment. And so in our view on that side, it's an exciting time to be thinking about the possibilities. On the pure investment side, last year we announced a $2.5 billion commitment to investing in clean energy initiatives. All indications from our investment team are as we're tracking ahead of schedule in that investment commitment. And to me, that signals that there's opportunities out there. And as we look at those opportunities, we're not just investing in climate or ESG related companies or technologies because it's the right thing to do. They have to meet our internal investment hurdles, right? And it's not again, investing because it improves reputation or other dynamics. It has to produce returns. There has to be something in the investment thesis beyond this feels like the right thing to do. We're finding those opportunities. And again, I think with the Inflation Reduction Act, that those opportunities are only going to increase. But again, as we look at the investment side, we're making financial and strategic investments where it makes sense to do that. And again, believe there's opportunities out there.
And again, I think this is a place where climate risk, I think, takes a more holistic and systems level view to be able to assess risk within your portfolio as well as identify opportunities. So within Liberty, we consider infrastructure risk, to be a climate risk multiplier. So that means that it doesn't necessarily matter what sorts of disasters are impacting our portfolio. Weaknesses in our critical infrastructure will enhance those losses. And we've seen that over and over again in recent events, whether it's power grid failures associated with the Texas freeze event or hurricanes Fiona or Ida that have just also caused massive power outages. Those exacerbate any existing losses and make them bigger. They make sort of the business interruption bigger, they make the larger economic impacts bigger. And unfortunately, it's an area where, as an insurer, although we pay the bills that are associated with those infrastructure failures, we may not have a very direct way to identify, hey, this is something that is going to cause an exacerbation of our risk, and we don't really have a lot of influence on the decisions that are being made there. My favorite example of this is after the Texas freeze event. The following year, there was another cold snap, and the Texas power grid very proudly showed that they were winterizing their facilities by wrapping them in saran wrap and duct tape, as that was going to help to make sure that they didn't freeze this time around and cause the billions of dollars of pipe burst damage that the insurance industry paid for. So being able to identify where those risks can happen can help us think about risk not just at the single policy level, which is where insurance has traditionally been strong, but scaling that up to the community level. And we want to make sure that, because of the fact that climate risk is a new challenge, it's different in scale than many of the hazards that we've dealt with in the past, that we can identify where there are trade-offs between individual risk reduction and community scale risk reduction. So for example, you might decide that, if you're a homeowner and you are at risk of flooding, you may decide that it's worth the investment to raise your home up on stilts so that it's above base flood elevation, and you've reduced your flood insurance premiums, which is wonderful. It'll reduce your risk of your home for the long haul. The problem is, what happens to the 2,000 of your other neighbors who are at exactly the same level of flood risk, who now haven't had any risk reduction done for them? Raising your home is expensive, it's individual resilience, and it costs a lot of money. How can we identify the point where it no longer makes sense to do sort of the individual resilience, but maybe it's time to invest in, a seawall or a levee to reduce the risk for the entire community? So I think being able to proactively identify where those trade-offs can potentially happen and communicate those out to communities is an area, again, where I think the insurance industry is uniquely well placed, but needs to be a part of our climate risk management conversation and shows the critical role that infrastructure can play. So we need to not think of it as just what's the investment of this, one single piece of infrastructure, but rather how does that infrastructure serve as a risk mitigator for its entire community.
And in that broader context, making sure that as those sort of more community-based infrastructure investments are being made in the broader picture, that they don't have the unintended consequence of sort of a negative impact, on a company's credit rating. So how do we look at that more holistically so that we are incentivizing the right behavior while at the same time, being responsible about credit and financial risk?
And I think there's some real opportunities for sort of public-private partnerships here as well, because you can imagine if you're trying to, fund a municipal bond to fund a piece of infrastructure, there is the value of that piece of infrastructure as an investment. But think about for the municipality, what is the value that that infrastructure is providing in protecting, say, its property tax base to make sure that those future investments can continue to be made? So I don't think we've done a really good job so far of communicating not just, the one-off investment opportunity, but rather the holistic view of pairing, is this a sound investment sort of from a, sort of traditional view, as well as the value that it brings in economic stability for an entire region and climate-related risk reduction.
So let me step back into, I guess, the reporting world again. Companies are in the business of staying in business. And for large, sophisticated companies like those that are represented on this panel, tremendous focus has been placed on understanding the risks related to climate and weather events that are evolving. So, from your perspective, what information in what format is important to know for investors, for rating agencies, and for regulators?
Yeah, so at the risk of beating a dead horse, I'm gonna again focus in on what I think is working well today, and that, in my view, is TCFD's kind of four-pronged approach around climate risk management, climate governance, climate strategy, and then goals. I do think SASB offers more of a quantitative and a accounting-oriented overlay to some of those themes, and goes a bit beyond that I do think provides some useful information. But again, companies that are not engaged in substantive efforts around those four pillars may find themselves at higher risk, both in terms of direct exposure and lost opportunity. As investors and other stakeholders look at the long-term prospects of that company. So, you think about risk management. Insurers insure against weather-related events. So, as weather-related events become more severe, I would think stakeholders would want to understand how we identify, assess, and mitigate risk. To me, that seems like table stakes, how our risk selection and modeling and pricing and limits work in that regard. On the governance side, you think about how we're set up internally to identify both risks and as importantly, opportunities to participate in energy transition. And then strategy, how are we building out products? What's our invest agenda? Both in internal invest and invest in green initiatives or securities. I think, again, that provides useful information to investors. Finally, targets and metrics. How are we holding ourselves accountable for progress? That to me feels very much in line with traditional notions of materiality. And again, I mentioned it earlier, it can be, if you are performing in these areas, that could be a proxy for operational excellence of your management teams and boards, which again, in most stakeholders, I think that would qualify as very important information. So again, I do think the SEC pulls some of those pillars in, and I think that's a good thing. But to the extent the concerns arise, it's around kind of extending beyond those traditional notions of materiality, and then creating kind of practical concerns around the ability to provide reliable and decision useful data.
Yeah, I think it's kind of instructive to look at the history of catastrophe modeling within the insurance industry to understand how physical related hazards were incorporated into insurers' book of business, because prior to the advent of these tools, we essentially used sort of actuarial tools that used history and curve fitting essentially to try and predict what losses could be. And it eventually became clear that that was no longer sufficient. But when we initially started putting together these tools, we didn't have a lot of granular information. The amount of information that we had actually looked a lot like what things look like in our investment space today, where we didn't have a lot of geographic detail. We didn't necessarily know which perils different things were exposed to. Maybe you had state level information or county level information, which honestly is even more than we have on the investment side. So I think being able to identify where granular information about our actual built environment, because really the built environment is how we will experience many of these climate related changes in hazard, I think is an important step and something that can be help to break through some of the barriers in analytics that exist today. But there's one other piece that so far doesn't exist on the investment side, and it's related to this lack of granularity information. But I think it's worth calling out because, again, I think this catastrophe model example is instructive because the catastrophe model includes a couple of different pieces. There is the hazard itself, which is what we're working on in the climate modeling space, and there's a lot of work to be done there. There's the exposure, which is what I'm talking about, of knowing where your stuff actually is and some basic characteristics about it. But those relate to each other through a vulnerability function. So how does hazard produce impacts to your book of business? And in the investment space, that vulnerability piece is incredibly underdeveloped. What climate impacts will cause an effect on your investments, whether it's through business interruption, whether it's through your stock prices, whether it's through your risk of defaults on municipal bonds. We don't have a great relationship today between where your investments actually are and how climate affects them directly. And you can only begin to build that out by knowing a little bit more information about where those risks are and some characteristics about them. So I want to call out that particular function, that vulnerability, how climate related risk actually plays out in the balance books of companies, as something that we don't understand all that well today and that we're trying to explore. And I think there's some real opportunities. Some of it may come out in the SEC disclosures. Some of it's coming out in the TCFD reporting that we're doing now, because TCFD is really focused on how you can incorporate climate risk into your strategy. How can you can incorporate it into decision-making. So thinking about climate risk from the framework of how much climate risk would I need to see in this particular area for it to affect my decision, for it to affect my risk appetite, essentially a reverse stress test within your own book of business rather than a prospective, this is what I think is going to happen in 2050, can help to make that climate risk much more actionable when it's sitting within companies and therefore more valuable to disclose from the perspective of investors.
I think what at the highest possible level, when you're sitting at the SEC and you're developing a rule like this, what you're ultimately trying to achieve is the dissemination of consistent, comparable, reliable information relating to climate risk. Of course, there's voluntary information today, but it has not achieved that core purpose. And there's a lot that goes into that. There's enforcement, there's auditing, there's assurance, and so I don't want to lose sight of the fact that that is a complex undertaking and multifaceted undertaking, but that's ultimately what investors have been asking for in this space. So in terms of format, most SEC rules traditionally have been a combination of qualitative information, qualitative disclosure, and quantitative metrics, most public company disclosure rules. And there's plenty of speculation as to what would happen in the final rule for climate. But I'd broadly expect that kind of mix of qualitative and quantitative information to continue under this SEC as they continue to develop rules in the sustainability space. Now, you might ask the more difficult question, which is what specific metrics can and should be required? And to that, I would say that's a question that's actively being debated by the staff of the SEC right now as they respond and review over 10,000 comments and move toward finalizing this rule. So the market feedback that you received during the request for information and during the proposed rule itself right now is going to be really critical as the SEC figures out what works, what doesn't work. And so that's really that responding to what the market tells us is can be done or cannot be done or is costly or vice versa is what the bread and butter of the SEC staff do, and that's what they're doing right now.
Yeah, I think that what you've described, and certainly at the NAIC as we developed the revised disclosure form, climate disclosure survey, that is an incredibly important element. That sharing of information and really using the process to become better educated, whether at what phase you do that, whether it's before you release the initial or while you're evaluating those. Because I think this really in every area of insurance, but particularly with respect to this because of the breadth of it, it's so important that we be guided by the science and what is possible and what is usable. And I think that this exercise will hopefully be an educational exercise, not just for the SEC, but for really all regulators that are looking at this issue, whether it's purely from an investor's disclosure standpoint or other disclosure standpoints. Because I certainly have found just in the process of this session and our preparation of this session, tremendous amount of very useful information that goes well beyond sort of just the focus on the SEC's focus. So with that, I really want to thank everybody for the discussion today. I know we could go on for a really long time. We have only 45 minutes and what could be a minimum of 45-day discussion on these critical issues. So thank you again for each of our panel members, and thank you for the audience for being with us today.
I'm Andy Mais, Connecticut's Insurance Commissioner, and I do hope you found attending the second annual Connecticut Conference on Climate Change and Insurance as rewarding as I did. We brought together a national audience with climate experts and industry leaders to openly discuss the impact of climate change on insurance and to better understand how climate change affects our communities, our regulatory efforts, and our businesses. I'd like to thank all the panel members who shared their expertise and helped define the issues facing us as we seek to mitigate climate change. Thank you to our audience members for attending, learning, and hopefully bringing the issues discussed in the C4I back to your own businesses and communities to carry on the fight. If there is one takeaway from this, it is a need for action, not just words. Recognizing the dangers we face is just the beginning. Now we need to act. This conference was recorded and can be accessed and viewed on the conference website and on the Connecticut Insurance Department's YouTube channel. We look forward to hosting this event next year with new speakers, updated and we hope positive information, and more solutions for this global emergency. Thank you.